Hello everybody, this video is a special compilation of a series that I did called The Iceberg of Finance, where in a typical iceberg meme, I will break down terms and concepts in finance from the simplest surface level stuff to the deep, dark, crazy. And back then, my channel was a lot less popular, the production quality wasn't as good, there was a lot of audio errors, and so in this video, I'm going to compile all the icebergs into one long video so you can watch it all at once and clean up the sound and some of the production issues to have a smoother, better experience. If I should do this for some of my other series, let me know and enjoy the iceberg. In this video, I present to you the first part of a series called The Iceberg of Finance. For those of you who don't know, because iceberg memes seem to be more of a Gen Z type thing, an iceberg meme basically shows a topic, and this one is going to be financial markets. I mean, there's so much juicy stuff about financial markets. I probably could have made a whole nother iceberg meme just on these. That it's the top level is the surface level, family friendly, obvious stuff about the markets. They're kind of little fun facts. And then as you go down below the surface, just like an iceberg, the deeper it gets, the bigger it gets, and the darker it gets. And as we keep going down this iceberg layer by layer, it gets more crazy, it gets more dark, it gets more conspiratorial, or just unusual and unexpected. And the thing is, if I made this iceberg, I tried to avoid like unsubstantiated conspiracy theories. Basically, there's so much weird actual true things in the world of finance that I was able to make a very in-depth iceberg. And then there will be in the show notes, you could see the link to the image, and I showed it in the cover too of this video of the full iceberg, so you can see all the topics we're going to cover. But for this video particularly, we're going to start with the first layer, which is the sky, which is above the surface, just the really kind of general facing things of finance. And we're going to go through these points, what they are, and why they matter, and just enough for you to start. If you want to deep dive into each of these topics, you can look them up. So with that begin, let's start with level one, the sky level above the surface. So the first one we're going to be talking about above the surface is the idea of bulls and bears. It's common lexicon in finance that a market that's trending higher is a bull market. Generally, if it's a 20% or more off the trough, is considered the start of a bull market, and it ends if it suffers a contraction of more than 20%. And you have a bear market, which is the exact opposite. It's a contraction of 20% or more, and it ends when you have a 20% or more rally. I mean, those are the technical definitions, but generally, is it a time where investors are adding risk and prices are going up, or investors growing more cautious, taking off risk, and prices are going down? So why are they named after these two animals? There is no defining theory or proof of historical record of any evidence that's like, this is the thing. But there are a few ideas out there. These terms started to be used in the 16th and 17th centuries originally. There was a popular spectator sport, if you call it that, during these days called baiting. It's where you would tie a wild animal and have it be like harassed by dogs or be forced to fight other animals or people or whatever it is. And people would just watch this for entertainment. And bulls and bears were two popular animals that were used for this sport. And I think that maybe a bull market refer to is that the bull was more likely to be used in good times because the animal maybe wasn't needed for meat, or maybe the motion that a bull attacks is through charging up with its horns. Maybe that's why they use the bull. Whereas a bear, people don't really necessarily eat bears or have other uses for bears, so when times are tough, maybe you couldn't use the bull for baiting, and so you could use the bear instead. Also, bears tend to slash down
And so maybe that is why that bear is used for when it's a bad economic environment. The other origin story is that in the 1700s, the short sellers were known as bearskin dealers because they were selling the skin of a bear before they hunted the bear and took it off, which is kind of like what a short seller does in the sense that they sell the shares that they don't own. And so these bearskin sellers may just, over time just became referred to as bears, and therefore a bear market. There isn't really no similar other or counter origin story for bull markets. So it seems like that's the bull baiting and bear baiting is the closest thing, but otherwise it's just a mystery. Wall Street is not just a single street in New York, where it is a street in the southern tip of Manhattan, but that it also is a term that is kind of like Silicon Valley, where it extends beyond the geographic area of Wall Street. Silicon Valley is not just people who live in the area of San Jose, California, and the surrounding cities. It refers to anybody who works in hyper-growth tech or a big software company or big tech hardware company that is in the United States. That is now Silicon Valley, even though it may not actually be. There's the physical place still too, but it's also just a catch-all term for anybody who works in high tech. Wall Street is a street where the New York Stock Exchange is on. I've walked down it several times when I've visited New York. However, it also refers to anybody who works in capital markets, whether it's asset managers, traders, investment bankers, people who are professionally involved in investing, speculating, or brokering deals in the capital markets. That is Wall Street. So you have people who work in Wall Street professions all over the country. I live just about as far away as you can from Wall Street in the 48 continental U.S., yet I'm still a Wall Street professional. The name Wall Street comes from the fact that when New York was still part of New Netherlands, the Dutch colony, the Dutch citizens built a wall on what is now Wall Street, a wooden palisade wall to protect from an invasion to the north. Didn't do any good because the Royal Navy just sailed into their ports from the south and captured New Amsterdam anyway, which was changed to New York. The wall was torn down once the British came in because the wall was designed to protect the Dutch from the British and was no longer needed anymore. And where the wall used to be, there became the street, Wall Street. And why is Wall Street the place that finance is regarded? It's because that's where the New York Stock Exchange, or what was eventually built. But before there was a stock exchange, there was a beech tree near a church on that street where the laws of the city at the time is where securities dealers would go to exchange their goods with each other and trade. That was like the designated spot, was this beech tree. And as the industry grew, they needed a proper building to do it in, and it evolved into the stock exchange, which is just hanging out by a tree. So that is all about the origins of Wall Street. Funny thing is, though, is that especially with technology over the past 30 years and the internet, the physical place of Wall Street has continued to get less and less important, whereas like the financial industry and cap trading is done just about everywhere. In fact, even due to a lot of tax policies and suburbanization, you see, it started with hedge funds going to Connecticut in the 80s, but it's now growing to a lot of banks and other firms are now moving to Florida and Utah and Texas and a bunch of other places. So Wall Street's everywhere now. It's not just the street. And that leads us to our next topic, is the Rule of 72. The Rule of 72 is basically a shorthand for the time it takes for an investor to double their money depending on assumed rate of return. So what you would do to solve this formula is 72 divided by your expected return is how long it's going to take to double your money. So if you get a 10% return a year, it'll take you a little over 7 years to double your money. And this just shows the power of compounding. When you can consistently get compounding good returns, your money grows a lot faster. It's not what happens in one day, 1 week, or even 1 year. It's really wealth grows just through compounding. Speaking of compounding, that's the next concept on the sky level of the iceberg. Compounding is the idea that you could have your returns compound on each other every year so that you end up making a lot more money on, even though the percentages of your returns every year stay the same. So if you put, say for example, a penny in the bank in the year 1600 and you had a 2% return every year, that doesn't sound like much, but if you compounded that over time, then by now you would have all the money in the world. It's the same with like say if you put, for example, you got 2% a day on $100,000, you would have all the money in the world probably within 2 years. It's compounding is powerful, and the faster you compound, the more powerful it gets. But there's other implications to this. Like when anybody promises you that you can consistently get 2% a day trading, that's probably not true. Just because, as I've told you, if you put in just even $1,000 and you got 2% a day for every day for a year, so 1.02 to the 365 times 1,000. Yeah, 1,000 would turn into $1.3 million. If you did it with 10,000, it'd be $13 million. And you don't see any of these day traders, so starting with their $1,000 to $10,000 accounts, they're not all millionaires over a year. If they were, then nobody would work, and all these systems that people sell would basically replace the need to actually produce capital or supply labor. And that's also, but that's like maybe the negative side of compounding. But the positive side is that if even a much lower rates of return, say like the best hedge fund guys do, is they get 20% a year, like the Warren Buffetts and the Sam Druckenmillers, like the real best investors. And if you get 20% a year over 20 years, you're going to get 38 times your money. So if you put $100,000 and got 20% a year, that would turn into $3.8 million. So also that's how you expect your retirement. That's how your retirement does go through saving more too, but it's the power of compounding is it really allows true wealth to be developed. And it's also why social mobility people are afraid of is kind of low, because it's a lot easier to compound if you have a bigger amount to compound with. Like it's just eventually, if you have long enough of a time frame, things work out. And I think that's the other thing about compounding. The other reason why we have this so-called wealth inequality now is people are simply living longer. And because they're living longer, they get to compound their wealth over a longer period of time before it gets cut by either estate taxes or dividing it up a large family. So compounding explains a lot of how finance works and wealth grows. And you want to use compounding in your favor versus against you. Like if you're borrowing and you keep paying interest on something, that's the power of compounding working against you. Like when you get a mortgage, you end up paying almost the same, like at least half the amount of the principal of the house in interest payments, just because it doesn't sound like 3% a year doesn't sound like that much, but over time, it's just years and years of paying that interest. It compounds, and and this is how also credit card people get in trouble. It's not that much 1 year, but over time, that interest you pay compounds, and that's why banks historically have been able to make so much money. Whereas if you're an investor and you have that your compounding is working on your side, and you gain from your interest payments that you were receiving, or your returns on equities or real estate or other assets compound every year, and that same factor that works against the borrower works in your favor. It's not quite that straightforward because you have to factor in inflation, but overall, compounding is a powerful force and it drives the entire financial services industry and the global economy. Albert Einstein even said the eighth wonder in the world is compound interest. And I think he's right. The next thing we're going to be talking about on this iceberg is IPOs. IPOs are initial public offerings. Like if you are a business and you're growing fast and you need to raise some money, but you don't want to get into a bunch of debt or the banks don't trust you for some reason, you would do is you could float your shares public in the form of an IPO. You get an investment banker, they put together all the legal things, they go on a roadshow to get the initial amount of investors you need interested in your stock, and then once that's all done, you go ring the bell at the NYSE and you're public and your stock is trading on the stock exchange. IPOs used to be the only way you'd go public, but now, or spin-offs if it's an already public company. But there's been other methods over time that have grown more popular, such as reverse mergers, SPACs, which we talk about level 3 of this iceberg, and direct listings, where a company they don't need any money, but they offer to float a portion of their shares as listings so that insiders and early employees who have made newfound wealth staying with this fast growing company can have the opportunity to cash it out. IPOs historically have like a big bounce on like 5 to 20%. It's a lot of people try to trade IPOs just by buying in before and selling right the day of. It's more popular on the retail level because for institutional investors, there are compliance headaches with dealing with IPOs generally. But the reason why you usually get a pop is because the bankers underprice the stock historically as a means to make sure the deal gets done and that the market shows a positive response initially to the IPO, because nothing looks worse for an investment banker than seeing an IPO crash on the day it goes public, because then future companies who are looking to IPO will be like, hey, this bank, they're clearly not doing something right because my stock is crashing on the first day. But it's at the same time, you could argue that maybe those bankers who are doing a better job because they got you an above market price. Whereas if you have a huge pop on the IPO, it means that you got undersold and you could have raised a lot more capital with that same amount of equity. So there's two different ways of looking at it. That's an IPO is a whole nother debate, but yeah, that's what I have to say about IPOs. And the next one, the origin of the capital markets. So why did the capital markets emerge in the first place? Why do we have things like stocks and bonds? If you want to learn more about this, a good book to read is Neil Ferguson's The Ascent of Money, which I will put a link to in the show notes of this video. So the capital markets emerged for different reasons. The first one we'll start with is the bond market. Bond market was mainly a necessity of modern warfare. I mean modern, I'm talking about like Renaissance Italy is where the modern bond market really started to develop. These cities had a longer term sustainable income due to trade and other things, but they didn't have the population base to supply enough taxes in the near term to cover their wars without killing their golden goose. But they also needed the money to fight these wars, otherwise they would no longer be an independent city-state. So the Medici family was part of this, but there's a lot of others who's like, look, we need to float bonds. We need to, I mean, there's plenty of wealthy people in our city that would have the capital for this to help finance this war, but the thing is that there's got to be a way to have them voluntarily contribute, and the way they've done that is through the bond market, where you would basically, instead of having to borrow it all from a single bank who did not have the resources to take on an entire government's debts for a war, or taxes in the near term, there's not enough tax revenue to cover it. Bonds offer a way to pool the financing of the cost of the war. So instead of, like, say for example, they needed to raise 1 billion of Florence silver pounds. I don't really know what the currency they used over in Renaissance Italy, and they do that, instead of having, they can issue that by splitting that million silver pounds into bond contracts of 10,000 each. And by doing that, they can have 100 buyers each buy one of those, instead of having one person have to take on the whole risk. And then you could divide it in smaller pieces too if you want a bigger crowd. And that's how bond markets work. Like, for example, the US runs $1 trillion+ deficit every year. There's nobody who could take that on by themselves, not a single bank, institutional investor, or individual who could take it on entirely on their own. And so we split the US government debt into pieces known as bonds. And this started with the wars in Renaissance Italy, and it spread everywhere because it worked really well for the Florentines and those other, and so that's why we have a bond market. Why do we have a stock market? Stock market was kind of like a similar need to pool capital, but instead of governments, it's private businesses. And back then, private businesses were not considered the most creditworthy institutions. In fact, governments were barely creditworthy. You'd be amazed looking at interest rates historically in the eras of the Rothschilds in the 17 and 1800s. They were considerably high. And the default rates for sovereign debt during all the revolutions going on in Europe in the 18th and 19th century were seriously pretty high. And so if government bonds were not considered risk-free like they are today, why would you lend money to a private business, which is even more risky? So the Dutch came up with this idea of pooling equity. This originally started as joint stock corporations. That's where the term stock comes from. In many other countries, they call it the share market, because that's really more what it is, that you have shares. A stock is essentially a share of a publicly traded company. And so if you finance things such as the Dutch East India Company or the first colonial expeditions in England, you would sell shares of these joint stock companies and to pay for the project, and you'd get a bunch of members of the British nobility and other wealthy individuals to each buy a share instead of the whole thing. The similar reason that the bond market originated. There wasn't a single investor or whale out there who could put the bill by him or herself. So instead, you had to pool out the equity. And that's why we have stock markets today. Companies needed to raise money for various reasons, and therefore you have stock markets to help be able to facilitate that and have it easier, because it's easier to get a small amount for a bunch of investors than a large amount from a single one. Until about the emergence of SPAC IPOs, share issuance had been down for a long time because of private equity getting involved earlier and earlier, and these big institutions willing to write bigger checks up front. But then as there's been more enthusiasm in general for stocks, and particularly tech companies at any price, a lot of companies are now skipping the private stage and going straight to public, because the valuations are now higher in the public markets than they were in the private markets, whereas this was the reverse about 10 years ago. Things are like this, move in cycles. And the insurance market, how did that start? Well, the insurance market actually started as an orphans and widows fund for Scottish clergy. And that is how we got insurance, because basically they had an agreement that people had to pay in for a certain amount so that like if you died, your wife and kids would have something to live off of. It was kind of like life insurance before life insurance. So this eventually came for other communities, developed these mutuals too, outside just the Scottish clergy and throughout Scotland and England. And that's how the origin of the insurance markets came about, is that basically people died for either because of wars or disease, or just life expectancies were generally lower. So, but they often left behind wives and kids who couldn't support themselves entirely. And so that's how this thing evolved. And the applications of it have grown over the centuries. And insurance companies remain a big source of capital and a big profit driver in the financial economy today. The last one I'm going to talk about for this one is DogeCoin, or DoggyCoin as some pronounce it. DogeCoin is a really weird story. It was created by some software developers in Silicon Valley as a joke, mainly as a way to be able to easier transfer poker winnings among themselves. Also, there are some ideas to use it as a way to pay to give gratitude, kind of like Reddit Gold, to various comments on various internet outlets. And it, thanks to the endorsement of Elon Musk, which we'll get to my views on Elon Musk when we go deeper into the iceberg. Dogecoin took off from being worth nothing to 60 cents, which doesn't sound like that much, but it put its market cap at well over $50 billion, and it was worth more than a lot of major U.S. companies, such as major airlines and major food producers and retailers. At one point, Dogecoin was worth more than Marriott hotels, for example. It was crazy, and it was literally designed as a joke. I'm not going to get into the merits of crypto. You can watch my other video, which I'll have in a little caption here if you want to hear my thoughts on that. But it's and then like it kept going until it was well hyped about a couple months ago when Elon appeared on Saturday Night Live, and they thought, oh, this was going to be the coming out party for Dogecoin. But then, like, he came on there, and everybody who bought in anticipation of his big pump up lost. Dogecoin crashed 50% the rest of that weekend because there was nothing left to it. That's the lesson. Buy the rumor, sell the news was learned by a lot of Dogecoin speculators who probably didn't have that much history as professional traders. And it still has a positive value now, believe it or not. And people will just say on internet, like just TikTok and social media, like, oh, Dogecoin to the moon, because like the world is crazy and stupid enough that why can't the craziest and stupidest asset go up? And that's kind of in the mentality. It's the meme of memes. And speaking of Dogecoin, the other funny fact about it is that if you put your money last January 2020 into Dogecoin between then and April 2021, the return you got on Dogecoin, which was I think well over 10,000%, was more in that year and a half than if you had put your money in the S&P 500 for the last 30 years, which is mind-boggling. That just shows you that shows you the power of like the fact that, I mean, the power of compounding, I mean, in terms of daily returns, but that is a crazy story. What turned into a joke has made and lost people billions of dollars over the last year. I originally included in the sky level in the image, but this time around I'm going to move it down one level, and that is Libor. A Libor, for all of those who are not familiar with it, stands for the London Interbank Offering Rate. Basically, when banks need to loan each other money when they're in a pinch for 24 hours, or there's a posted interest rate on an annualized basis. So that would be Libor. So when banks feel confident that they're healthy and will be able to pay back each other, and or central bank policy interferes with this rate, Libor falls. If banks are skittish and think, oh, maybe one of my fellow banks is at the risk of default, then our Libor will go up. And or it's just general interest rates go up for other reasons. Libor is important because a lot of interest rates in the economy are based off of Libor. So say, like, for example, you have a margin account or your brokerage account. If you want to post margin overnight, you're going to pay Libor plus a certain spread. It'll be quoted as a Libor plus 3, which means you're going to pay whatever Libor is that day plus 3%. So if Libor is, say, 1%, 1 plus 3 is 4%. And it's not just margin accounts. Interbank loans, corporate loans, even some just shadow banking type loans to small businesses. Like, I met a lender when I was playing tennis who offered me Libor plus 3% for any small business who needs money. Okay. And then if there's, you don't really see mortgages priced necessarily in Libor spreads because they have their own market and they have strong collateral in the house itself. but it's very commonly used in finance. The dark side of Libor, it had a history of manipulation. About a decade ago, Barclays was caught manipulating Libor, and a lot of other banks were participating in it. They kept it artificially down when banks were feeling a squeeze, and artificially high when they felt they could make an extra buck doing so. And they got caught by regulators, and a lot of people are faced severe legal trouble for being involved with it. It kind of exposed to how a lot of the financial market is more manipulated than it seems on the sky level. I mean, everybody in Wall Street knows that there's games occasionally being played in certain asset classes, but the fact that Libor, which is one of the most important, biggest price setters in all the financial markets, was involved in a fixing scheme is that much more concerning. The next one we're going to talk about are derivatives. Derivatives are seen as a boogeyman. Like you always see like financially uninformed media or people say, oh, our economy is so unstable because there's all these derivatives out there, or the banks are going to fall apart any minute because of all these derivative positions they have on their books. A derivative is not just some spooky boogeyman that means excess leverage. A derivative can mean a lot of things. Just a simple definition of a derivative in a financial sense is a derivative is a financial instrument that moves based off of the movement of an underlying instrument. So this can include futures contracts, which trade on commodities or currencies and stock indexes. It can include options, which are the ability to buy a security or a futures contract at a fixed price at a future time. If you want to know more about options, I've done several videos on options. I will post one right up here on my screen onto your right, or I will also link them in the show notes too. But yeah, options are a form of derivatives. Then there's also forward contracts, which are the agreements to be able to borrow money at a certain exchange rate for currency forwards, or to accept payments in a different currency, or in the case or interest rates. And then there's swaps, where you exchange two different source flows of cash, one side to the other. These are usually mainly used to hedge currency risk or interest rate risk, or credit risk, even some of them, things such as credit default swaps. But mainly what their purpose is to do is to allow institutional investors to hedge certain risks in their portfolios. And that's why a lot of the derivative gross exposure doesn't really mean anything to me, because it's a net exposure. A lot of these banks, yeah, they hold a lot of gross exposure in derivatives, but most of their positions cancel each other out because they serve as a market maker to cancel against a position that they take the other side on. Yeah, I'd be more worried if a bank was all in on a certain direction or a certain level of volatility and needed a certain outcome in the market to happen for their derivatives to be made whole. An example of maybe this, they weren't really quite a bank, but a brokerage that got in trouble with this was MF Global in 2001, who had a big bet on European sovereign debt recovering. They were right, but 2 years too early, and MF Global went under as a result. So that's really what's more concerning on the derivative side, is whether they have an excess net exposure one way or the other versus a gross exposure. The banks make markets in these things, and they get paid a premium to do so, and so a lot of their positions are just netted out. So, and derivatives, they allow more precise, and often in the case of the options market, if you do it correctly, more favorable risk-reward ways to get certain exposure in the marketplace. On the other side, a lot of people use these. Now, it used to be big hedge funds and banks pre-2008, but now it's more retail investors nowadays to get more leverage than they could trading underlying. And that's the dangerous, improper way to be using derivatives. So those are my thoughts on the derivatives market. The gold standard is kind of like Camelot of Wall Street. It's this idea, and I'm sympathetic to the gold standard personally, because it did work pretty well pre-World War One in most of the Western economies. It was this idea that every dollar, I'm just going to use the United States as an example here, but it applies to just about every country in the world. Every dollar is backed by a fixed amount of gold. This really started effectively in the late 19th century when you got rid of bimetal standard, which was the currency standard before where you had gold and silver as legal tender at a fixed ratio. But then the silver supply started to dwarf the gold supply, and this created a lot of inflation that wouldn't have been there otherwise. So there was some controversial elections about this in the late 19th century in the U.S. It's William Jennings Bryan's Cross of Gold speech comes from. And actually, the Wizard of Oz, fun fact, is rumored to be an allegory of the gold versus silver debate of how you should have inflationary or deflationary monetary policy, and when metal, and that's why in the book versus the movie, Dorothy's slippers are not ruby, they are silver, because silver is the pathway for farmers in Kansas to be prosperous, because farmers benefit from inflation. And the yellow brick road represents gold and the powerful interests, and Oz is the big city that benefit from the gold standard. Fun fact. But the idea is that basically every dollar is backed by gold. So if I went to a bank, I'd be able to exchange $1 for 1/20th. The gold standard is an idea that you can exchange your gold for a fixed amount of dollars, or your dollars, more importantly, for a fixed amount of gold. For most of American history, this is at $20 an ounce. It was changed in the early 1930s to $35 an ounce by President Roosevelt. And then when Richard Nixon closed the gold window in 1971, the value of the dollar in gold was freely floated, which means you couldn't go to Fort Knox or a bank and exchange it for gold. Now gold has gone up from $35 to over $1,900 since 1971. You do the math on what that means for the rate of decline on the dollar if you assume that gold is actually the hard source of money. And the reason why people like the idea of the gold standard is that it kept the government honest in terms of its spending. It was very difficult to have excess deficit spending because your ability to finance that was limited by the bond market or taxes. Raising taxes obviously is not politically popular. Raising bonds can work, but if you don't have a central bank to buy the bonds for you, there's only so much paper that the investors are willing to buy before they demand a higher price for it and get worried about your solvency, so interest rates would go up. And this is what would happen. So if you had a non-competitive economy, and this is what happened in Europe between World War I and World War II, which is what caused the gold standard to get into trouble. If you want to know more about that, I recommend reading a book called Lords of Finance, which gets into how the gold standard unwound in the 20s and 30s in Europe. And because these countries were not economically competitive on the manufacturing front, while the U.S. was, because they weren't damaged by World War I. So on a gold standard, your trade balance is your gold balance. So if you have consistent trade deficits, you're shipping gold to the country that's providing the surplus, and you're giving up your own gold. And because you have less gold but the same amount of currency in your country, the value of your currency declines. And when it comes to when you have more gold for the same amount of currency, the value of your currency increases. And so this is supposed to be like a self-correcting mechanism. So if a country keeps having consistent trade deficits and is not competitive, their currency will be cheap, and therefore they'll be able to compete on the global market with cheaper products. And so therefore, because of that, people will import from this country and they'll get their gold reserve back. And it was this nice, smooth equilibrium. It worked well until World War I, when governments had to temporarily suspend their gold standards to print money to finance the war. And when they tried to get back on the gold standard at the same fixed rate as it was pre-World War I with that additional amount of money supply, it wreaked havoc in the economy. What they really should have done is they should have seen what the effective market view was, the market rate for that gold would have been, and just pegged it to a lower level. That's how you would have, and then just let the old balance of payments way of settling your gold balances correct themselves. The other thing is Europe was struggling with crazy radical politics and it didn't really, and a bad economic system. So they weren't able to recover as quickly from the war as expected. And so therefore that natural flow and balances didn't really happen. The U.S. ended up with all the gold. And that's kind of why the gold standard started to break down. It's mainly because governments needed to cheat to finance World War One. So war is effectively what destroyed the gold standard, or the beginning of the end. And then in the 70s, with the finance of the Vietnam War, the U.S. government cheated with guns and butter money printing policies. But they thought they could sneak a fast one on the rest of the world. But then when countries such as France started demanding their gold back, Nixon realized the game was up and just let go of the gold standard. So historically, financing wars or excess government spending is what destroys the gold standard. And because you can't have excess government deficit spending beyond the means of taxpayers if you have your currency honestly tied to gold. And that's why you have a lot of the weird economic problems in terms of like bad public finances, income inequality, asset prices going up in dollar terms but not in precious metal terms. And actually, if you want to learn more about this, there's a great website called pricedingold.com, and it will just show you like every asset class or consumer product that has like an index divided by the price of gold. And it's amazing how flat a lot of these charts are. Like I'll post the one about housing in this video, and as you'll see, housing prices, even though they've gone a lot up in dollar terms and gold terms, they've pretty much done nothing in the last 100 years. Similar with food prices and most other consumer goods, but the one that's been consistently trending down is wages. And that explains why you have a lot of, I would say, social tensions, because wages have been collapsing, not in dollar terms, of course, because we keep printing money, but in real purchasing power terms. So, yeah, gold stand. Then there's the main, like, I'm going to try to be fair and neutral here. The main argument against the gold standard is something called Triffin's dilemma. Triffin's dilemma is basically the idea that you have too much, like the economy grows past a certain point, and gold realistically can only grow at the rate that it's mined, which is historically maybe when you have a prosperous year for gold miners, 2 to 3% of the total world's gold supply, which is not that big. You can fit almost all the world's gold supply in 2 Olympic-sized swimming pools. So, yeah, I mean, the main problem with Triffin's paradox is that when you have a global reserve currency, such as gold in this case, you need to have it grow at a certain rate to fill all the needs of the growth of the global economy. But if gold is not mined at fast enough of a pace to cover that, then you get major financial volatility and squeezes. And because liquidity dries up, that causes interest rates to go up, it causes defaults, and then an economic depression. Like, the downside of the gold standard was that there was a lot more economic volatility, which has humanitarian and social consequences when people go bust on their loans and jobs are lost and a variety of other variables. An Austrian would argue this is just the market cleaning itself out from its excesses, where somebody who's more interventionist in their economic beliefs say, I'm fine with having inflation and having savers lose if it causes less people to get thrown out of work and less violent recessions and violent inflationary booms. And just, I'd rather have my losses on my currency purchasing power being consistent than have a stronger currency power, easier to save at the expense of a more volatile economy. So you're basically choosing between economic volatility and a truly clean, cleared market. That's a debate I will maybe get into on another video if requested, but I've already spent enough time on this iceberg talking about the merits of the gold standard. So let's move on to the next topic, which is OPEC. For those who aren't familiar with OPEC, OPEC is the Organization of Petroleum Exporting Countries. They are basically a cartel that controls the supply of oil that is available on the international market. Prior to 2011 and the fracking revolution, they had a lot more power. In 1974, OPEC, in response to the U.S. support of Israel, decided to basically embargo export of oil to the United States and caused the spark that would cause nearly a decade of abnormally high inflation. In the 2000s, OPEC was able to keep oil prices high because you had a new buyer in China absorb a lot of demand, and the rest of the world hadn't caught up yet with supply. And this is how you hear about how, like, the stereotype of how rich, like, the sheiks of Dubai and Saudi Arabia and Qatar and Kuwait, this all came from this oil money. It's always been there, but it really, the peak phenomenon of, like, the pop culture of oil money from the Middle East was in this 2002 to 2008 period when oil had its highest prices in real terms of all time. At one point, it got as high as almost over $140 a barrel. OPEC's membership has varied over the years, but I mean, right now it's 13 core countries. Most of them are in the Middle East and North Africa. Saudi Arabia is by far the biggest producer. They actually have less proven reserves than Venezuela, but Venezuela's political turmoil means they're not actually producing that much. So in terms of production, Saudi Arabia produces almost as much oil as the rest of the OPEC countries combined. And the next two in size are Iraq and Iran, who combined produce about 80% of what the Saudis do. So yeah, the main players are Iran, Iraq, and Saudi Arabia, but there's other countries too, with the most notable ones outside of the Islamic world being Nigeria and Venezuela. Indonesia, Ecuador, and Qatar used to also be part of OPEC, but they have left for various reasons. Qatar for geopolitical reasons, and Indonesia mainly because their domestic demand for oil went up enough that they were not a material exporter anymore. So that is OPEC. What if they were doing this on a national level, or if a private company was doing something like this, it would be illegal. Cartels are not good in a free market economy. They keep prices above what they would be otherwise. But since this is done on a sovereign national level, they can get away with it. At least they were able to, really, until, again, the fracking revolution. The U.S. became the world's largest producer of oil again. But then as a response, OPEC created OPEC Plus, which was the original OPEC countries plus the cooperation of several other major oil producers, the most important of these being Russia. And so if you have Russia plus the main crew at OPEC, now the cartel has a lot more strength. And since OPEC joined, they've been able to have a much stronger influence to at least help keep oil above a certain floor. I'm not going to get into the fundamentals of the oil market. That's another time. But basically, OPEC is a legal cartel which has caused a transfer of wealth that would have gone to other places into these oil-rich exporting countries. Depending on how well the country is run, whether the people or the rulers have disproportionately benefited from this in these countries is up for you to decide. Again, I've done that video and some of my other podcasts back in the day, but that's not really a finance topic. The next one I'm going to talk about is Ponzi Finance. Ponzi Finance it comes from the term the Ponzi scheme, which is this invented Charles Ponzi, which is essentially the idea that you have an investment that the only way it works is that if more people pay in than take out. So like how a Ponzi scheme works is, say I am Charles Ponzi, is that he promises a certain return to investors, and then he gets more investors in, and they put in the money, and then he pays the old investors money to newer investors' money he gives to the older investors and claims that they are profits. But you can see that this doesn't work because you always need a consistent flow of new investors to come in. And once that stops coming at a fast enough of a pace, then the whole scheme falls apart and the losses are exposed, because the Ponzi scheme never actually created any value or actually did any investing. It was just a shell game. I mean, the most notable examples, of course, are Charles Ponzi's original scheme and later Bernie Madoff. So now Ponzi Finance, however, is not really referred specifically to Ponzi schemes. When I am talking about Ponzi Finance, it's really the idea that there's a lot of aspects to the economy where there's companies that particularly and investment schemes that really rely on, only survive on more people putting in money than pulling out. There's not any actual wealth produced through the fruits of the labor or the capital in the given enterprise. As an example, this is zombie companies where they're deeper in this iceberg, but that company, like a lot of these unicorns, a tech, for example, where they can't finance themselves through actual revenue and profits, so they have to keep raising money at higher valuations to keep the party going. I mean, so it's or like another example would be a lot of cryptocurrencies. They're not Ponzi schemes like the way Charles Ponzi did them, but the only ways in the way they move up is not because they actually produce any value for, say, there's not like they're not creating a dividend. It's that more people are putting money in than out, and they go up. And if more people pull more money out than in, they go down. This is also the same in the art world or any other collectible. Has this mechanism of Ponzi Finance. At least the term I think originally comes from Boston Consulting Group, and I'll put their article in here as a link, a reference link. But yeah, I mean, there's too many of these types of Ponzi finance mechanisms in our economy, and it's probably going to make things a lot more unstable than they otherwise would. So just when you look at an investment and just think, how will I expect to get my return? Is it it's from more people just putting it in than taking it out? Then that's a little bit scary. Or if the capital's being invested and does produce something that eventually generates profit, then you have a more sound footing. Hedge funds are another one of these boogeymen in finance that really aren't. A hedge fund really is an investment vehicle that an asset manager invests in a variety of assets that are not available to mutual funds, and a lot of strategies that are not available to mutual funds. And in exchange, the catch is that hedge funds are restricted only to accredited investors, which by rules in the United States, I think is about $250,000 a year the last 2 years for an individual person, or $300,000 for a married couple, or $1 million net worth, $1 to $1.5 million net worth excluding a house. And the reason why they do this is to protect people who are uninformed and risking their life savings from something that is too speculative for what our regulatory authorities perceive as their risk tolerance. I get why they do this. I think the accredited investors rules should probably be based more on education levels than just pure amounts of money, because there's educational knowledge of what you're getting your money into is probably helps you better understand what you're risking than just the amount of cash you have. But the point really is that that's what hedge funds do. Like, there's hedge funds that do long short strategies, which they go long buy a certain amount of stocks and they short sell a certain amount of stocks against it to keep a relatively neutral portfolio and try to get returns just on their ability to pick winners from losers. There's macro funds, which is most of my career's experience with. It's just they make big bets in futures contracts and indexes of countries to figure out what the global trends are and who's going to profit and why. You have trend following, which uses more technical analysis, which I surprisingly didn't include in this iceberg, but there'll be a technical, if I ever make another iceberg, it will include a lot of technical analysis stuff and generate money that way. They're just, again, they're just a more unconstrained version of traditional investment advisors. There's plenty of, hedge funds, there's nothing really secret about them that makes them inherently inferior or superior investment. In fact, actually, hedge funds have been underperforming consistently since the 2009 crisis. But that's also because the target return of hedge funds is not the S&P 500, which, if that's your target, you got to just be heavily long a few big tech stocks. They have different goals, and that depends on what their investor statements are and what their plans are, because there are hedge funds all over the place. That's not really what this video is, explaining hedge fund strategies. I'll do that in a different one. But yeah, they're just another part of the market. Pork bellies and orange juice I use as a reference to obscure futures contracts. Futures contracts are basically something that you can buy to or sell to really lock in a price to buy or sell a given underlying commodity, currency, or index. They're originally used for farmers to lock in prices if they wanted to sell their grains into the export market through Chicago, or for buyers, like say if you're a bakery and you want to lock in of your wheat, you can buy a futures contract, and so you'll know you won't pay more than this amount in term delivery. And you can set, they have dates throughout the year for these. I'm not going to really get into the mechanics of futures contracts in this video, but when the mainstream culture thinks of futures contracts, the two that come up most often are pork bellies and orange juice. And I think why this is the case, because they're just kind of silly. It's just the idea that people are in the pits in Chicago, or digitally nowadays, but in Chicago trading and aggressively trying to set prices on things as obscure as packages of orange juice or slabs of pork bellies always captured the imagination in a humorous way. Orange juice in particular, reference comes from the movie Trading Places with Dan Aykroyd and Eddie Murphy, where the villains in the movie try to make money from getting a USDA crop report in advance for the orange juice market in Florida. And the protagonists trick these greedy traders by sending them a report that has the opposite implications of the real one. And so then these guys load up in based on what they perceive as insider information, but it's really a red herring. And so when the actual report comes out, they lose all this money in their orange juice contracts, and when they try to get out of the position, they yell, "Sell, Mortimer, sell!" And that's become like a funny quote. And Trading Places is probably, even though it's from the 80s, the movie that most people think of when it comes to futures trading, or there's like the pop culture reference of it. And so orange juice futures, they've declined in popularity considerably since I've started my career. I remember when I first used FinViz, which is this tool I use to check a lot of my charts and things. Orange juice used to be something that was tracked and the futures listed there. Now it's not. They still are trading. It's just their volume is quite lower than it used to be. I think part of it has to do with people being more conscious of sugar, and so they're not drinking as much juice, period, particularly orange juice. And yeah, they've just become a less popular contract over time, and also maybe people start to prefer to trade index futures and other things. And then pork bellies, those got discontinued outright in 2011, and there are no pork belly futures anymore. When people ask me, what happened to the pork, well, do you trade pork bellies? And I'm like, I don't know, they haven't been around in 10 years. I missed that boat. So yeah, that's the futures market. Next, I'm going to talk about short selling. Okay, short selling is another one of these. I'm covering a lot of the boogeymen perceived that aren't actually boogeymen. A lot of people like to blame the shorts for a lot of bad things that go on in the market. But really, a short selling is basically a way that you can trade to make money off the prices of things going down. You borrow shares, you sell them immediately, and you hope to buy them at a price that is lower. It's not always easy to short because If something is popular among short sellers, the market makers and the brokerage houses know that. So in order to lend the shares, they'll charge you a much higher interest rate. So if you are, say, for example, want to short a hard to borrow stock, the interest rate is 20% annualized. If the stock goes down 20% and you hold it for a year, you don't make any money. So they have to move, not just move down in these more popular shorts, they have to move down fast for you to make money. And that's why a lot of these will buy, people who want to trade hard to borrow things will buy puts, but the puts are often bid high because, again, people don't want to pay the high borrow cost. But yeah, shorting is just, and I think shorting makes a market healthy. And it's often, I did a video on whether the world will ban, U.S. will ban short selling. I'll show a clip of it. I'll put it right here in this part of the video, and also have a link to it. But short selling has a role because it allows for more honest price discovery. If people can find the bad things going on in a company or see that prices are excessive, short selling is kind of a self-correcting mechanism the market has. Also, when you do have a real market turmoil, the first people to buy the dips or the bear markets often are shorts because they got to cover their positions. And in order to cover your position, you got to buy the shares back. And that's why often when you have a lot of rallies in the markets, any asset class, they're usually started by short sellers. And short squeezes are popular because that's when too many people get short at the same time. So when they have to cover, you see a massive movement higher. So short selling can work both ways. So that's my thoughts on short selling. The next one is MOMO. MOMO is short for momentum investing. Momentum investing is something that consternates a lot of more value-oriented investment professionals because there really isn't any logical sense to it. But it's just the idea that if you're a momentum trader, you buy whatever's been going up a lot recently, particularly in the last 3 to 12 months, and you sell or short the stuff that's going down a lot over that time period. And by doing such a strategy, academic studies have actually shown that these type of strategies outperform just buying and holding, and by a material amount. It's about 1% a month. And some of these momentum trends go back to as early as the 19th century. The main risk from Momo strategies, one, it requires a lot of turnover. You got to watch what's hot or what's not. The second challenge of Momo investing is how do you know when the momentum is going to stop? Because these things, when they go parabolic, it's very difficult to know when the party's over. And usually when you get such a big move up, you get just a violent, if not faster, of a move down. And so momentum strategies tend to have very high drawdowns because it's not just like you go on a ramp like this and then it just flatlines. No, like what happens is that you've got momentum stocks that they go up, but then they go down just as fast. So that's, or faster. And so it's like playing hot potato with the market. So a lot of people I know have made quite a bit of money off Momo. It's personally not what I do, even though maybe I indirectly incorporate it through some of my trend following risk management procedures. But yeah, it's out there. It's kind of silly, but it strangely works to a certain degree. But it's like selling volatility. It works really well until it doesn't, and then it blows up. Share buybacks is the last one we're going to talk about on this iceberg. I know these are getting kind of long, but these are deeper topics. I may have to split up the future layers into multiple parts, given how long this one video is going to be. This one's probably going to be over 40 minutes. So a share buyback is simply when a company buys back shares of its own stock to boost the value of the stock. So say like if I'm Apple, and I made a bunch of money and I don't really have any more capital investment. I'm good with my factories. They can produce all I need. I already have enough money I spent on research and innovation or wherever I'm growing. So what do I do with the cash? I just have it sit in the bank. I can use it to pay off debt, or I can write a dividend check and pay it directly to my investors. But the most popular option is using share repurchases or just buying back the shares. And this has become very popular in corporate finance for for multiple reasons. First, you can have a tax perspective. Since dividends are taxed higher than long-term capital gains, you can argue it's more tax efficient just to buy back your own shares and shrink the float. And because that, your earnings per share rise, and thus the value of the remaining shares rise by whatever you would have paid as a dividend, if not more. And then instead of getting right a dividend, investors can sell the amount of shares they need for income purposes instead of they're waiting on a dividend check. There's also the more cynical reason that a lot of CEOs, executive bonuses, are priced off of share price. And what's the easiest way to boost your share price, all things equal? That's to shrink your float and buy back shares. And even if it would have been better to pay your investors a dividend, you'll do the buyback because it's better for your bonus payment. I'm not saying this is their ultimate motivation, but you can see how there's incentives like that are there. Share buybacks were actually illegal for a large time in American history due to them being accused as market manipulation. But then buybacks were legalized in the 1980s, and then after that, you've seen disproportionately much higher stock markets. And so it was 1982 when the SEC passed Rule 10b-18, which created a legal process for buybacks. They became exponentially more popular after the 2008 crisis when companies were struggling to grow their top lines due to struggling demand. And so if they wanted to boost their earnings per share, what if your earnings are flat? How do you do that? You got to lower the shares. And this also, there's studies to show that this has been an effective strategy because the country, when you look at a country by country basis on the performance of stock indexes, the countries where the most amount of net buybacks of shares take place is the ones that have the best relative performance. Buybacks are fine as long as you're using cash that is on your balance sheet that you can afford to use on buybacks. Where buybacks become a problem is when companies borrow to buy back shares and then just get themselves into an unsustainable level of debt and become zombie companies, which I talk about in a separate video. And also we're going to go in that and that's in layer 4 of the iceberg. It's all about zombie companies. That's where I have an issue with it. I mean, as long as when companies don't have the cash to buy back shares but do it anyway, that's in my opinion not a good idea. The next one we're going to talk about is Tulipmania. Tulipmania was a phenomenon in the early 1600s. The reason why that Tulipmania is as famous as it was because it was the first speculative bubble in a semi-advanced economy that we have really good record or good enough records of price action. I mean, there have been speculative binges as early as ancient Rome. And if you want to learn about the history of speculation, I recommend reading a book called The Devil Takes the Hindmost, which I will also put a link to in the show notes of this. But Tulipmania stands out because it was kind of the first of its type. The Dutch economy was the first country to ever have a stock market and publicly traded companies. They had a lot of other innovations in their economy to really have the first truly modern economy. And that's why the Netherlands, as a country as small as it was, had a really powerful colonial empire and geopolitical sway throughout the 17th century. So Tulipmania kind of really started in the early 1600s. The tulip was originally brought to Europe through the Ottoman Empire because it was a Turkish flower, and through trade after the Ottomans started to invade some of the Balkans. And it made its way eventually up to the Netherlands, where it became a very popular luxury item. And then there's a variety of different colors that had different rarities, kind of like, I don't know, like baseball cards or cryptocurrencies or things like that, different levels of scarcity, and people started to trade them like collector's items. Classic cars, another example of this. And then kind of started to take a life of its own. There would be certain like bars slash coffee shops where people would go just to discuss tulips or to broker deals for tulips. It became it transformed from a status symbol to a chance to make a quick buck. Like there were Amsterdam merchants who went to collect tulips from far lands and would make 400% margins on the journeys. This thing lasted for almost a decade, but the peak run of Tulipmania really started in 1633, and then that's when it really kind of started to capture the imagination. But then when it really took, like, the peak parabolic rally was November 12th, 1636. And from November 12th, 1636 to February 1637, tulips rallied from using the index that I'm using here on my Wikipedia page, $10 a bulb to over 200. I mean, it wasn't even US dollars, obviously. They're using Dutch guilders, I believe. But for tulip bulb contracts, though, went up 20x. And a lot of people made a lot of money real fast. But then from February 3rd to May 1st, they dropped back to November levels. And this thing completely collapsed. And it's also, there's a few implications to the tulip mania. One, it shows the potential, the madness of crowds. And that something that is of as little intrinsic value as a tulip. I mean, tulips are nice looking flowers, but they don't have that long of a shelf life, especially if they're in a pot, not out in nature. And they don't generate any sort of cash flows. But people will speculate on things when there's a perceived shortage, or if the price goes up enough, it captures the imagination. And it's the first real good written example of that type of speculation. We've seen this in other assets such as .com stocks in the 90s, railroads in the turn of the 20th century. You've seen it with cryptocurrencies recently, Pokemon cards also around during the time of the tech bubble. You had a similar phenomenon with the South Sea bubble and the Mississippi Company in the 18th centuries. So these things happen on relatively rolling basis, and in housing too. There's several different housing markets in the history of the world that have had speculation. But there was with housing, you had a rent cash flow or a use as a shelter. But some of the, like, Tulipmania particularly stands out because there wasn't really a strong economic original argument for it, other than the fact that somebody was willing to pay a higher price. And that's why I think it's captured the imagination so well, because it really shows the folly of greed. And I think there's some lessons that can be applied to current speculative markets right now when it came to Tulipmania. The other explanation, at one point, at the peak of it, a single bulb could get you like a house. It could get you 8 fat pigs, or it can get you 1,000 pounds worth of cheese. It was a kind of a, oh, actually, no, I'm reading that wrong. You could get a house, but you could get a whole basket of goods, including 2 lasts of wheat, 4 lasts of rye, 4 fat oxen, 8 fat swine, 12 fat sheep, 2 hogsheads of wine. I don't even know what a hogshead is in terms of measurement, to be honest with you. 4 turns of beer. A hogshead is just a giant barrel. It's about a fourth of a turn. And then you've got a complete bed. You get a whole bed, a whole closet full of clothes, and a silver drinking cup. So you can basically start your own life as a gentleman farmer for the cost of 1 tulip bulb at the peak of this thing. And also in the Netherlands, you see pictures of like the Dutch countryside, and what do you see generally? 2 things. You see those windmills that help drain out the water because a lot of the Netherlands is reclaimed. And then you see the tulip flowers and the gardens sprouting everywhere. Why are tulips so common in the Netherlands? Well, that's because of this. Now let's move on to our next one, which is taking delivery. I talked about futures contracts on the surface level. And slightly below the surface, we're going to talk about the idea of taking delivery. So if you have a futures contract, and say you buy a contract that's 1,000 barrels of oil, and it is due on July 1st, and you do not sell that contract or exit the position before delivery date, in theory at least, you are stuck with taking delivery of the oil. And usually the people who hold these things in delivery are real users, end users, such as for an oil contract, for example, airlines. They need the oil to turn into jet fuel to fly all the planes around. That's why they're an end buyer. Or a meat processor wants to buy live cattle or lean hogs. But sometimes they're speculators, well, they're usually not individual traders. They're often a big bank's desks or hedge funds, something like that, who just lose trade so many futures and they lose track and forget to exit their positions. And as a result, they end up having to take delivery. Taking delivery means you have to physically pick up the goods from the clearinghouse or wherever the seller has them and bring them to where you're going to take them. Because that's the agreement of the futures contract. If you hold it in delivery, you have to take it. Some things isn't a big deal, like currencies or stock market indices or bonds. These deliveries settle in cash. Others, they're physical goods. Sometimes people intentionally take delivery, and even on the investor side, like the University of Texas pension fund has famously taken physical delivery on gold futures contracts it's bought over the years. Others get stuck with these by accident. There's a lot of old stories, and some of them may just be myths, but whereas like a futures trader loses something, and then like I think Goldman, for example, had a trader, again this is maybe apocryphal, I'm not sure if it's actually true, but accidentally took delivery on a contract of live cattle, and therefore had to take 100 cows and store them somewhere and feed them because they were his cows. He had it, and the farmer wanted to get rid of them, and he had to contractually obligate to take them, and so therefore he had to set up a warehouse and a feed stall and just keep these cattle until he had somewhere to put them. There's also been similar stories about people getting sent bushels of wheat to their garage or a basket of corn. It's really kind of funny. It's like, oh yeah, you forgot your futures contract. You get a call from the exchange saying, hey, Mr. Smith, we got to send you now 1,000 lean hogs because you forgot you didn't take delivery. Because you didn't close your contract, so you got to take delivery, and you have the next couple of days you have a bunch of pigs shipped to your house. It's just funny thinking about it, honestly. I mean, I think there are a lot of brokerages and clearinghouses have safeguards to prevent this kind of thing, and there are also smart bidders who are end users who will take advantage of this opportunity and be like, hey, look, I know you accidentally are gonna get stuck with a bunch of pigs, but if you sell them to me for a heavily discounted price, we'll take those off your hands. And usually, just to avoid the hassles and the cost of storage, people will fire sale this and just take a big loss on the trade. So yeah, taking delivery is a real thing. Even though it seems like most of the stories you hear about are more urban legends, just make sure if you're long a futures contract to make sure to close it out before it expires or roll it forward to a future month. The other thing is the example of where delivery has impacted kind of the market on a more macro scale happened last year in April when oil, because due to the pandemic, oil wasn't being used because nobody was driving or flying and production was still up. You had an issue where there was nowhere to store oil, and on the last day of trading of the futures contract that month, the April futures contract, oil fell from $20 to minus $40 a share because basically people had to pay to get rid of the oil they were having because they had nowhere to store it. And I never thought I would imagine seeing a commodity like oil ever trade negative, but it just shows you about sometimes if there's nowhere to take delivery, you have to pay a steep price to find somebody who can store it. And it was a really weird day. I remember that when oil went negative. Something I never thought would happen. Let's move on to SPACs. Well, SPACs, we talked about IPOs before. A SPAC is kind of an alternative way to go public to an IPO. It stands for Special Purpose Acquisition Company. And they became more popular over the last several years. The only time they kind of had a limelight in the sun was the peak of the tech bubble. But it's basically a SPAC is a way to go public where you create an empty shell company that has the cash to buy a company that's private, and then instead of having to go through the formal registration or an IPO, this empty company that's is already public will just announce an acquisition of the private company, and then that private company is now a public company through the shares of the dummy company is created before it. Why would somebody use SPACs over a stock? Well, from an issuer's perspective, you usually generally generate a lot more fees from SPACs as a percentage of the deal than you would in a traditional IPO. Also, for both sides, the advantage of this is you can get your stocks a lot faster. So there's a hot market where people are willing to overpay to the moon for any price. The SPAC market is the way to do it because you don't know how long, say for example, electric vehicles are going to be a hot commodity. And so you want to go public at the highest valuation possible before people like sober up on the sector. SPAC is probably the way to go. So you see a lot of companies that are in hot sectors and are really early in their development that probably do not have the minimum qualifications to go public and don't have to, and also the other advantage of SPACs, it doesn't require as much due diligence, or you don't have to have a strong, you don't have to have proof of earnings or a lot of the other minimum requirements. So it's a lot more speculative grade type companies, things that would not really be public through the traditional IPO means. But if you want to get the deal done fast and you want to catch a wave, or if you want to try to sell something that normally in a less exuberant market would not be very attractive, SPACs are the way to go. There are some issues with SEC is looking into with SPACs, mainly the fact that they offered, a lot of these SPAC dealers offered privileged deals to insiders that they could buy shares of the SPAC, but if they didn't like the deal, they could sell it at the price they paid for it, not if the stock fell after the announcement, which is kind of unfair way to do it. In terms of me trading SPACs, I have never really bought one at like in the early game, but after they've sold off quite a bit, after the initial exuberance and the fact that people realize, hey, wait, we're overpaying for this SPAC, these things tend to panic, and then there's some dips that may be worth buying, because not every company that's a SPAC is a bad company or an overvalued mess. Some actually are solid companies, but we're trading too rich at the beginning, and then they come down, and it gives a good opportunity to buy. Yeah, that's my thoughts on SPACs. They're just a kind of a more speculative way to go public. The next one I'm going to be talking about is Zero Hedge. Zero Hedge is a website that started in 2009 by an ex-trader who had some issues that no longer had been allowed in the industry, and as a result he decided to switch to blogging. And Zero Hedge is originally kind of a niche thing more in the financial industry, but has gotten more diversified and developed more of a personality beyond just finance. The original founder's name was Daniel Evangelski, and he was a former hedge fund manager. Instead of writing as his own name, he writes as Tyler Durden. The whole website is themed in Fight Club, and the slogan for Zero Hedge is, on a long enough time frame, the survival rate for everyone drops to zero. I guess I need a lot of context here, but Zero Hedge has been it's been good at exposing a lot of inconsistencies in the marketplace. Like, they were one of the first to get behind the stories, say, of the high frequency trading issues in the early 2010s. They're known originally really was for being overly bearish. They still have a very bearish bias, And people who follow too much zero hedge, including myself earlier in my career, probably lost out on a lot of profits or even lost money short selling because they read too much zero hedge. It's something I think a lot of people go through in this profession. Ever since, really, as it evolved, it became more of just a general, like, right-leaning libertarian type news site along with bearish analysis on the stock market. Like, they even got banned by social media in 2020 for being one of the first people to talk about the lab leak hypothesis. I don't want this video to get taken down, so I'm not going to go into any more on that. And it was kind of funny because when they got their site banned, the market peaked within a couple weeks. Yeah, it's kind of from Twitter. So like, it's zero hedge is kind of like almost a contraindicator in a way, because they started right kind of near the lows of 2009, and then during the pre-pandemic peak, they were taken down. So yeah, I don't really read zero hedge as much as I used to. Sometimes they have some interesting headlines, and they historically are pretty fast to reporting stuff, and they provide a good bearish alternative, especially when most of the mainstream media, especially the financial television, is overly bullish. So they provide a good counterbalance. It's just that you can't let zero hedge influence you too much, otherwise that pessimism may hurt your returns. The next one I'm going to talk about is the Cayman Islands. For most people, are associated with one of two things. One, it's a nice spot to go on vacation. I went there with my last foreign trip pre-pandemic, and it was a fun time. The other thing that it's known for is the fact of monetary secrecy and low taxes. It's 0% income tax, 0% property tax in the Cayman, 0% inheritance tax in the Cayman. And so therefore, if you want to create an entity to minimize taxes, you base it in the Cayman Islands. And that's what a lot of hedge funds do, not for any tax evasion reasons. Actually, it's mainly because foreign investors who invest in a fund don't get double taxed, both in the residence of the hedge fund manager, which, say for example, is the U.S., and their own residence. They only get taxed on the money that their government believes should be taxed on their local rules. So it's just a way to prevent double taxation, which is the most common reason to have a Cayman entity more than anything more sinister. However, there is tax evasion going on, but I'm not really an expert in that. I can't really dive deep into it. They're also famous for having gold vaults and secret bank accounts that you can store things. Like, I've thought about getting a gold vault in the Cayman personally if I ever had enough gold for it to be worth it. Just mainly because, just in case if, say, the world powers decided to nationalize it, then maybe the Cayman's a better place, but maybe not, because it's still pretty integrated with the U.S. economy. And if the U.S. and the powers that be in the whole world decided to ban gold, I don't know if things would actually be that safe in the Cayman Islands, which is why I think a lot of these tax havens are starting to lose their effectiveness in a world of digital tracking of everything. I think the future of tax reform is probably going to have more just digital trails of things, and therefore I think maybe these tax havens may be at risk of becoming a relic of the past. I mean, it's still great for the people who live there. They don't have to pay taxes, but it may be harder for foreigners to benefit from these tax havens, especially with Janet Yellen's proposal of a global minimum tax. The next one I'm going to talk about is MMT, which is modern monetary theory. A modern monetary theory is really kind of monetarism to the extreme, but with a heterodox view that instead of interest rates that determine the supply of money, it's taxes. So basically, as long as there's not inflation, the modern monetarists believe that you could print as much money as you want without having to collect taxes. And that money should be used ideally for infrastructure, social spending, and providing guaranteed jobs to every worker in your country, as they think is the best use case of this money. And then therefore, because If inflation's low, it means that the government has room to spend. And so therefore, if you have a slow, like a economy that's not growing fast enough, or you have inequalities or other things that could be solved by more government spending, there's really no risk of doing it as long as inflation is low. And then, however, if inflation goes up, what these people believe the solution is not just to raise interest rates and tighten policy, and therefore that would result in the losses of jobs or asset prices falling and a variety of other bad things. Instead, they just believe raising taxes, particularly taxes on wealthy people, as the solution. Because if the rich are taxed more, they can't, or people in general tax more, they have less money to spend, and therefore the velocity of money goes down and inflation stabilizes. I mean, Hauser's law kind of shows that governments collect about, at least the U.S. government collects about the same amount of money no matter what the tax rate is. Like maybe you might do Hauser's law on a future iceberg, but that's a topic that's a little bit too complicated for this right now. But that's the point is that MMT is becoming popular all of a sudden because there's a lot of politicians who want to promise a bunch of things such as free college, universal health care, universal basic income, but they know that they can't ever raise enough taxes to cover. And given the trajectory of the U.S. government deficits and the deficits in other developed countries and the level of national debts across the world, it's not realistic to expect this to be paid back in equal value dollars. So people's like, oh, why not? Why just not spend? We haven't seen any inflation in the last 10 years, despite all the quantitative easing, which really just helped the rich. So why don't we use modern monetary theory just to like print money directly and give it to the people versus doing it this roundabout way that elevates housing prices and stock prices to help the rich versus everybody else. Personally, I'm not a fan of modern monetary theory. I don't really believe you can create something out of nothing like that and expect society to function. And when you do drastically raise taxes, there are at least income taxes, there are negative consequences to that, particularly disincentives to spend or make your capital improvements. So I generally don't think that would work. I'm more of a person who favors more stable money and higher interest rates. But this is not really about my opinions. It's just I want to see modern monetary theory and expect it to gain more and more traction, especially among those who want to give more and more goods and services on the public dole to the people. The next one's quantitative easing, which I refer to in MMT. Quantitative easing, or QE, is what it's known for. It was a program first initiated near the bottom of March in 2009. It was basically just the Fed printing money to buy bonds to stabilize the financial market and mortgage-backed securities to help stabilize the housing market. It worked as it caused a lot of the financial assets to stop free falling and that people invest money. But every time the Federal Reserve had ever hinted at stopping quantitative easing, they've always had to double down with a bigger amount at a faster pace. So we then had QE2 a year and a half later, then QE3 started in 2012, and then when they tried to unwind that through first tapering and then raising interest rates, so the markets did not react very well to it, and it caused a strong rally in the US dollar and a flat market during the tapering. And then once interest rates really started to rise, you had a mini crash in the late of 2018, which then they had to reverse a lot of that effort. And then the pandemic happened, and then they just took it to a whole nother level where it's basically no end in sight, because basically our the main consequence is that by suppressing rates so low, the actual rate of interest would be much higher in a world without quantitative easing. Because if the central banks around the world, and the Fed was only the first one to do it, all the other major central banks have done something similar. If you let the market clear, then the natural rate of interest would probably be much higher, and as a result, a lot of these asset prices could not sustain these valuations because they only make sense because the interest rate environment is so low, and nobody wants, particularly baby boomers, who are just entitled to believe that their stocks and their houses can never go down. It's politically very unpopular to let the market clear. And also because there's so much debt and leverage based off of perpetually low interest rates, it would probably risk a default cycle too. So you're kind of stuck. And QE didn't cause traditional inflation because a lot of this money didn't really go directly into the hands of the people like the MMT people are proposing to do. Instead, it went into banks, and it's not like what a lot of these conspiracy theorists say, oh, the banks used QE money to buy stocks. No, it didn't really work that way. What it really did is that interest rates went down so low that pension funds who used to buy bonds or other people who used to buy fixed income have to move up the risk curve to get that yield that they need to fit their obligations. And so therefore you've got a lot of people forced to speculate who wouldn't otherwise, and therefore you had a much bigger bid for the assets, and that's what drove the asset prices up. And then also things that do have income generation, such as real estate, is priced on based on the overall interest rate environment. And if the overall interest rate environment is lower, housing prices go up because that same amount of rent, even if the rents don't go up at a lower interest rate, the house price should go up because that income somebody will pay to get a slightly higher income than they would in a bond. And so therefore you get bidding wars for houses among institutional investors. So that's kind of why you've seen housing prices were able to bounce quite a bit, and that resulted in both higher rents and making increasingly unaffordable housing for the millennial generation. And that's really where the inflation came from. The other consequence of QE is deficit spending, because if interest rates are just kept down, politicians have no incentive to cut spending because there's no immediate consequence in the next electoral cycle. And so therefore we've had much larger government debt to GDPs in any non-war period of time in world history. The next one we're going to talk about, speaking of taxes and fiscal policies, carried interest is the idea, this tax loophole that hedge fund and private equity people have, that investments in their funds are considered long-term capital gains, even on their performance fees, even though it's based off of trading that more often and work that more often than not would be considered ordinary income. So their example is that your carried interest, say if you have a 2 and 20 hedge fund, you get 2% of the base and 20% of the profits, and you made 10% on it. And say if you're running a $1 billion hedge fund, so you collect $20 million on the management fee that you use to mainly cover your expenses, and anything you do make off that net expenses you pay as ordinary income. Whereas say your carry, which is 20% of the profits, which would be another $20 million, you only have to pay long-term capital gains on that, even though it's kind of like income earned in a way. And even though you've seen all this income inequality, tax the rich sentiment, Occupy Wall Street type stuff, anytime carried interest is mentioned, loophole to be closed, it's never really gotten anywhere, because a lot of these same donors who support a lot of progressive leaning causes also happen to be working in the hedge fund and private equity industry and protect their personal interest. Next one is China as a currency manipulator. This is an assumption that the Chinese government has been deliberately suppressing the value of its currency, the RMB, renminbi, or the yuan. There's many ways you could say it, in order to keep their exports artificially more competitive than they would otherwise. There are some evidence of this happening, particularly when they pegged their currency during the Asian financial crisis in the 1990s, and the relatively low volatility in the RMB, which originally was pegged to US dollar, but then was changed to the SDR, which is a weighted average of several world currencies. But you could look at it the other way too, is that you can argue that China held up its currency artificially strong, and there are fears of that as well due to a lot of capital outflows. Like, what China is doing is that they chose a different form of the Impossible Trinity, which we're going to talk about deeper into the iceberg. But they decided they wanted to keep a relatively fixed exchange rate in the exchange of capital controls. So you can't freely move your money in and out of China. There's a lot of restrictions to that. And that's how they're able to keep their currency at a level that it wouldn't be if it was freely floating. Is China a currency manipulator? Probably. The question really is more so is which way are they manipulating? Are they trying to hold up the currency, or are they trying to keep it weak? I think that answer's been different throughout time. Don't fight the Fed is a popular slogan among traders that nothing else really matters other than central bank policy and monetary policy. You could have an economy that's rolling over, that's structurally broken and relying on zombie companies and paying people not to work, and you have structurally low growth, but as long as liquidity is going up, you still can't short the market because you can't fight the Fed. Or if the opposite, say maybe, the economy's doing well, but if the Fed's raising interest rates, you can't own risk assets because tighter monetary policy will outweigh the good things that are happening in the world. And so a lot of people, a lot of smart hedge funds managers particularly, got in trouble for trying to fight the Fed several times during QE because the economy was the worst recovery in the history of the United States from 2009 to 2017 at least. You can argue maybe even as up till now that it was, and yeah, you had falling living standards in large segments of the population too. Companies for many stretches in those points, and multi-year stretches where revenues and profits and earnings were going down, but multiples kept going up. Why? And stock prices going up mainly due to multiple expansion. Why? Because you don't fight the Fed. They kept adding and adding more liquidity, and they were able to fight quote unquote economic gravity. And so that is why it's become popular to say, don't fight the Fed. The next topic I'm going to talk about are LBOs, which is short for leveraged buyouts. Leveraged buyouts are essentially when a private equity firm buys a company, but does it mostly debt, kind of like, it's not quite a mortgage because it doesn't have the payment structure, but it's kind of the same idea of buying a house with a mortgage versus cash. Your cash on cash return is higher because you don't have to put as much money down. And it's the same effect with LBOs, except unlike a house where the mortgage payment is fairly fixed, you can cut your costs of the business operations. If you think the business is poorly run or the management is overpaid or inefficient or whatever the reason, if there's an opportunity for cost cutting, you can cost cut and lower that cost and then use that extra cash flow to pay down the debt faster. And so you don't only accrete wealth from paying down the debt, but you also do it from a higher valuation when you sell it to either another LBO firm, or you take it public through the initial public offering, or sell it to a strategic buyer. And this has been a virtuous cycle for the last 4 decades because the LBO strategy really got started in the early 80s when interest rates were at their peak. And when interest rates fall, the interest expense is lower, and therefore it makes deals at higher valuations make sense. So the LBO multiples have consistently trended higher since the 80s. And so it's just this chain that just these private equity firms sell to each other at higher prices. It also helps that post '08 private equity got disproportionate inflows due to the fact that it didn't have as bad mark-to-market volatility in the financial crisis because the nature of private investments are less liquid. So that's a whole nother topic, which I may have to save for another iceberg. But the question now really with LBOs is, when interest rates start to trend up for a multi-year period, how does that affect the viability of this strategy? It's worked great on the way down. I'm not so sure on the way up. The other notable thing about LBOs is it's how 2012 Republican presidential candidate Mitt Romney made his money with Bain Capital, was heavily involved in these type of deals, and it was controversial to the practices that they used to cut costs. The next topic we're going to talk about are zombie companies. So what are zombie companies? A zombie company essentially, and I did a video on this too, so I'm not going to go too deep into it. It's a 12-minute long video. I commented on it, but that A zombie company is a company where essentially you have to borrow to pay back interest payments. There's kind of like this downward spiral that they can pay back the interest, but they can't pay back the principals. And a lot of companies got into the zombie condition by doing share buybacks when they didn't have organic growth, or to cover like a financial crisis or accepting bailout money. Banks are the most common assets to have be zombie status, especially in Europe and Japan. And the problem is that these things choke economic growth because they employ people in firms that are not financially viable in a free market. They prevent competition who is healthier from coming in and taking their place. And it just makes things a lot. And this heavy indebtedness also just prevents longer term strategic actions. And just look up whether it's the states bailing them out or it's companies getting really generous financing in a low interest rate environment. It's one of the causes why we've had what people think as a more structural stagnation in many aspects of the economy. The pandemic made this worse, where pre-COVID, like less than 10% of companies in America were zombies. Now it's most likely over 20%, at least the last statistics I've seen. Europe, it's over 25%, and Japan, it's even higher. Yeah, the zombies are not good in horror movies, and they're not good in the business world either. Again, watch my video for more on zombie companies. The next thing I'm going to talk about, though, is the Plunge Protection Team, which is kind of more of a nickname for a Washington organization called the President's Working Group on Financial Markets. It was started in 1988 by President Ronald Reagan. Whenever the market goes down, there's volatility, but you get a bid inexplicably. The Plunge Protection Team is often credited for that. It was created in response to the 1987 crash, where the market crashed 25% in a day, which I think is still the biggest percentage crash in a single day. It's basically the working group consists of the Secretary of the Treasury or their designee, the chair of the Board of Governors of the Fed, the chair of the SEC, and the chair of the CFTC, or their designated appointees. And what their role apparently is to stabilize markets and to, there's a lot of conspiracies that they work beyond their legal mandate, and they're buying things such as futures or ETFs or stocks to support the market or bonds when that's not really in their mandate. The evidence on it is mixed, but it's a common conspiracy theory in finance that whenever things get a little shaky, the Plunge Protection Team is going to come and save you. It's also explained kind of the evident bullishness right now in the market, because people think whether it's the Fed or like as I said in the Don't Fight the Fed in the last video, or the Plunge Protection Team, the government has your back. Maybe they do, but that's kind of my thoughts on the Plunge Protection Team. Next, we're going to talk about venture capital herding. Venture capital, surprisingly, like 1990 to 2020, and worse from 2000 to 2020, has actually, on a risk-adjusted basis, not been one of the weaker performing assets. You would have been better off just buying a levered Russell 2000 ETF, which is small cap equities in the U.S., than you would with venture capital. Whereas venture capital, a lot of people now do invest in it, particularly because it's a way to make an idle rich person look like they're doing something. And again, there's a lot of great venture capital funds out there. In fact, all the best deal flow tends to go to the top 8 venture capital funds. So if you look at the skews of the returns on on VC and a skew of alpha, it's heavily concentrated in those ones that get the access to deal flow. And there's a lot of smaller ones that are run by ex-entrepreneurs who actually kind of know how to see talent because they did it before. But there's also a lot of people who are becoming VCs just because it's a trendy thing. And there's this whole infrastructure. This guy, Jake Tran on YouTube, did a great video on it where you basically have a company, you buy it at a seed or a Series A, you tell your friends how cool it is, and they will bid it up at a higher valuation on Series B, and some other VC will bid it higher on Series C. And these valuations really don't mean anything other than on paper to make increase the wealth of the founders and the venture capital funds. But this herding to these few concentrated unicorns has created extremely bloated valuations in the technology sector or companies that are very popular among the VC crowd. And I thought they would have a problem when it came time to exit, or they would have to eventually show a profit. But since real rates keep falling, the timeline to having to show a profit keeps going away. And then the public market, either through traditional IPOs or SPACs, has been a very friendly place for a lot of these overvalued companies to get sustainable bids, because now the public markets and the retail traders have now a more venture capital mindset and are willing to skew traditional valuation and profitability metrics in favor of potential. So when it was really started as a problem in the San Francisco VC community in the early 2010s, that I thought would eventually result in there was a minor correction in the unicorns in 2018, like WeWork, for example. But it evolved really to that the public market became the new higher bidder and kept the train going a lot longer than I thought it would last. We'll see how this ends. Next, we're going to talk about is Jekyll Island. Jekyll Island is the island off the coast of Georgia where senators and bank leaders met to draft the Federal Reserve Act, and they did it in complete secrecy because the general American public did not like the idea of a central bank. Andrew Jackson got rid of the Bank of the United States in 1832 and paid off the national debt, and his populist belief was kind of more in line with the general public even 80 years later. But after the panic of 1907, the banking interests wanted to do something that wanted to arrest market and economic volatility, because the main consequence, as I mentioned, of the gold standard and a super hard currency is economic volatility. And the Fed, creating the Fed would do that, and lowering volatility benefited the bankers greatly. And they created the Fed as a private organization that has private shareholders but works in the interest of the government. And a lot of these private shareholders happen to be banks from that era. The fact that they did this in secrecy and they had another shenanigans around it has made people question the Fed. There's a lot of anti-Fed conspiracies. There are legitimate criticisms of the Federal Reserve. I'm not a particular fan of financial repression or keeping interest rates artificially low for extended periods of time. And I can understand why they do that, because there are vested interests who benefit from such thing. But not all the most wild conspiracy theories on the Fed are true either. And that's why Don't Fight the Fed is such a real thing, because Don't Fight the Fed is a derivation of a lot of the Fed, the cynicism towards the Fed through the Jekyll Island and all the conspiracy theories around it. If you want to learn more about this, read the book The Creature from Jekyll Island. The petrodollar is the idea that a lot of the Middle Eastern oil countries peg their currency to the US dollar and price the sale of oil in dollars, and therefore effectively the crude oil market and the trade of the crude oil market provides its support and demand internationally for US dollars and a reason to hold US dollars in reserve. And why do these countries are willing only to sell in US dollars is because they do that in exchange for military protection from the United States. Saudi Arabia and the Gulf states have major geopolitical tensions with neighbors such as Iran, and having the protection of the United States helps because these countries are ruled by absolute monarchs who use most of their funding on social spending to improve their country's living standards, so that people don't question the fact that they don't really have much political power. And they do spend quite a bit on military too, but I've had enough of critiques of Saudi Arabia on YouTube, so I'm not going to really dive any more into that. Find my other comments on that. But the general idea is that, so the dollar is priced in oil, and if countries decide to switch selling oil into other currencies, that it would cause the US dollar to collapse. There are conspiracy theories that Iraq was invaded by George Bush because they wanted to sell oil in euros instead of dollars, and the US was not going to put up with that. Same reason why Gaddafi got taken out because he wanted to sell oil in euros or in gold or some non-dollar asset, and Libya is a big oil exporter. China has recently released a futures contract that allows you to buy oil at price in yuan. Actually, they are the biggest net importer of oil now in the world. And so far, it really hasn't done much to undermine the dollar. The RMB has strengthened quite a bit, but I think that's more for other reasons that really are not relevant to the whole petrodollar story. So yeah, I think oil being priced in dollars does help, but I think that currency flows are driven by a lot more powerful variables, and the import-export balance of the U.S. is not entirely dependent on oil anymore, especially now that the U.S. is one of the biggest producers of oil in the world. The petrodollar may have been more important from 03 to 07 when you had the combination of high oil prices and large net importing of energy from the United States. But as fracking technology and new discoveries and more energy efficiency in the economy has kind of devalued the petrodollar. John Law is famous for the South Sea bubble. Some would argue he's the Elon Musk of the 1700s of that era, because he sold this imagination of the potential of the new frontier in America, when it's really just the territory he was doing is a bunch of swampland. And he gained so much power and influence that he was helping craft up fiscal and monetary policy for the French king. And it became one of the, prior to Bitcoin, the biggest percentage rally like in a single asset and in terms of scale. And it caught the imagination. Like, you had a speculative mania, kind of like Tulipmania, except the South Sea bubble at least wasn't. The South Sea company is actually a real company, and at least had a promise of doing something, which is settling the New World and extracting the resource from the New World. There's a similar company that came in this era as well, the Louisiana company. And when basically when the results couldn't live up to the hype, it collapsed as quickly as it rose, and John Law suffered the consequences in terms of his reputation and the law. And again, it's another example of a famous bubble in the economy. And next, we're going to talk about Taleb's Turkey. What is Taleb's Turkey? Well, this concept comes from Nicholas Nassim Taleb, and I have the chart posted as I'm talking about this. It's the idea when you sell volatility, which is basically betting on things just kind of staying the same, or that things that you're not factoring in risk as much as you should, like selling options. It's an example of a strategy that fits Taleb's Turkey. Your returns are very steady on the way up, and then one day it just crashed, and it's like the "and it's gone" scene in that South Park of the financial crisis. It's like the turkey. The turkey's life progressively gets better the first, say, 200 days of its life, and then November, shortly before Thanksgiving, its head's cut off and it's dead and its life's gone, like that. And that's why it's called Taleb's Turkey, because he uses the analogy of the Thanksgiving turkey. We saw this with the XIV and the short VIX ETFs 2018, where they steadily rallied for years, and then one day when the VIX doubled, which was Volmageddon, they went from $100+ a share to zero, like less than 10 in one day. And these things completely got destroyed. And generally, any sort of vol sale strategy, that's what eventually happens. The thing is that there's always an excuse on why this time is different, so people keep doing it. And it's also the path dependence of investors' preferences, and also the Sharpe ratios, which heavily reward low volatility and consistent returns over volatile returns, even if the volatile returns perform better on an absolute basis, make this type of pursuing a strategy that's a Taleb turkey trap to be financially appealing. So that's the story of Taleb's Turkey. You got to watch for the risks of that happening to you. And then the Chapwood Index is just one of many examples of this, but it's all part of the common theme that people do not believe the actual inflation numbers that the government produces. As part of my research service at my firm, I create alternative research data, alternative inflation data, to try to use more private sector analysis components to the CPI and see what I get in terms of an inflation print. It's generally higher than the government consensus. Not always, but the thing though is that a lot of people think that, but I don't think it's that much higher that it's severe to the point that people are becoming poor and impoverished nations in a decade. You've got things like the Chapwood Index, for example, or John Williams' shadow stats, which basically have argued that the U.S. changed the way it calculated inflation in the 90s, which is true. And because of that, inflation is way higher than expected. I think they are discounting some of the deflationary impacts of technology. But the thing is and that has lowered the cost or eliminated the cost of certain things. Like, say with an iPhone, I don't need to buy a camera anymore. I don't need to buy a Thomas Brothers book anymore. But yeah, I mean, like the Chapwood Index, for example, thinks that inflation is averaged in New York and Los Angeles 11.5% over the past 5 years, which I just don't find that to be credible. That means your living standards have gone down 50%, unless if your wages have gone up to match that over the last 5 years, which is just not true. I think in some aspects of the economy, you see Chapwood-like levels of inflation, such as real estate and healthcare. Those are due to more structural reasons and are more Fed sensitive. Other assets, such as manufactured goods, commodities, till very recently at least, and services where there are lower barriers to entry, the increased monetary easing is not just a demand booster, but it's also a supply booster. Like the shale crisis was often blamed on QE because they got a bunch of cheap capital to produce more cheap oil. So you can't really have it both ways with some of this stuff. I generally think, though, inflation is higher than what the markets expect it to be in terms through the break-evens and the TIPS bonds contracts. And I think the government numbers are a little bit understated, and there are valid reasons for them to do that, which, not to get too conspiratorial, but social security payments and income tax brackets are based off the CPI and are indexed to it, so they rise proportionately. So if you're a government and you want to raise taxes or cut spending without doing it directly, fiddling around with the inflation number is the best way to do that without people noticing it outside of economists and investment circles. Try explain the concept of the Chapwood Index to your layman who doesn't follow finance, and it might be a little bit over their head. So yeah, I mean, I think these things serve a role to like just you gotta question the narrative of a lot of economic statistics, not just inflation. Other ones might not be as accurate as per se. Like in some countries like China, like even the consensus believes that they're not real. But even in countries like America or Europe, you have to look at incentives, and you have to see the real world around you and see if it matches what you're seeing in terms of inflation and unemployment and other economic variables, and make personal and financial decisions accordingly. Enjoying the water? It's getting a little colder now down here that we're in part 5 of the Iceberg of Finance, which is a series I'm doing as part of my YouTube channel, Analyzing Finance with Nick. We're now starting to get into the weirder territory. I mean, Chapwood is kind of a little bit crazy, but now we're fully in now level 5. We're in the bottom half of this thing. Let's get started with the Impossible Trinity. The Impossible Trinity is a concept I learned about when I did my semester abroad in international economics, and it's one of the more interesting concepts that I learned, one of the most useful lessons I actually learned about in my undergraduate education. And it's basically the idea that a central bank has 3 goals, but they can only accomplish 2 of them at a time because of constraints. They are free capital flows, which means like if I want to go and exchange my dollars for euros, I can do it without any sort of barriers or restrictions or minimums or maximums. And people could freely move money in and out of your country. Then you have fixed exchange rates that no matter what, you're going to have the exchange rate be pegged. Say, for example, like with the Hong Kong dollar, which is pegged between 7.75 and 7.85 to the dollar. Fixed exchange rates are beneficial because investors and business people and importers and exporters have more stable prices, so they can make longer term decisions and not have to worry about FX risk or spend money on hedging or worry about currency affecting their costs or their pricing power. So fixed exchange rates, yeah, make things simpler in theory and make economic transactions more smooth and economic decisions better for the longer term in that theory. And then the third one is sovereign monetary policy, which means that a government can choose, or a central bank can choose whatever interest rate that they want. They don't just have to have it whatever the market demands based on capital flows, or have it at a fixed rate to match the interest rate of the currency that they're pegging it to. You can see that there's a problem with this. You can't have all three at the same time. Like if you try to have both a fixed exchange rate and do what you want in terms of your monetary policy and control interest rates, if your interest rate in your fixed currency is severely higher or is materially higher or lower than the country's currency you're pegging it to, money's going to flow in or out to whichever currency has a higher interest rate, and that's going to put pressure to the upside or the downside of your currency. Now, this is what happened with a lot of the Asian financial crises in the late 90s. They had a fixed exchange rate, and then they tried to be a little bit flexible in the monetary policy, and it caused crisis. China is an example who solved this problem. They wanted both of these goals through capital controls. Most people in China cannot take out more than $50,000 a year in RMB out of the country, because if you had free capital flows, then the Chinese RMB would have to trade at a different valuation than the soft peg it has right now. It's been increasing right now, but historically, especially when they were first growing as an industrial power, mercantile power, they kept their currency way lower than it would have been. And if their currency was allowed to rise, then China would have not been able to have such a big market share in global exports like they've been able to build. Or on the other side, they maybe have kept their currency too strong because a lot of people wanted to get their money out of China because they don't trust the political situation there, or feel like there's too much debt in the system. So a lot of the wealthy in China have been trying to get out money in any means. So you could argue maybe the currency is overvalued because these people haven't been able to get out money. Well, they have been to a certain degree through a lot of different means, but they haven't get out an amount as they would have in a free floating currency market. Then if you want what most governments choose is a sovereign monetary policy, which they control their interest rates, and free capital flow, like movement and money in and out, you're not going to have fixed exchange rates. That's why like the dollar and the euro and the yen fluctuate as much as they do, is because the market participants are reacting to relative interest rate spreads and growth prospects and other factors to decide which currency should strengthen or weaken. And if there's a big spread in real rates in one currency or another, or that's being anticipated, you're going to get mass inflows one way or the other, and it's going to cause the value of your currency to fluctuate. Western economies have accepted this risk for the most part, and as a result, you have an active forex trading market. The last combination you can have is free capital flow and a fixed exchange rate. Hong Kong is an example of this. Singapore, to a lesser extent, is an example of this. The Bahamas, a lot of countries peg their currency at a fixed exchange rate to the dollar, or euro, or some other major currency. And by doing this and having free capital flows, your main restriction is that you have to copy the monetary policy of the country you're pegging it to. Because if you don't, then you're going to people speculative attacks to short your currency, or people will pull it out because they don't trust it, like what happened in the Asian crisis in the 90s, or in Argentina in more recent times. Whereas if you try to have it like you're worried about inflation, like this will happen in Hong Kong, say in the last 10 years, but the U.S. keeping its monetary policy low because they've had need it for their own domestic reasons, you get housing bubbles and other speculative booms like what's happened in Hong Kong in its real estate market. It's probably trading way higher than it should be because the interest rates for the last several years have been way lower than they should because it's been tied to the US dollar. So the point. So you basically have to pick two. You can do Impossible Trinities for other things in life. Say, like, for example, finding a job that pays well, doesn't require many hours, and easy to attain. I mean, maybe in theory you can do that, but it's usually you got to pick two. And you could apply this. That's just one example I just threw off the top of my head. But you could look at a lot of life as these impossible trinities or trilemmas, and you have to learn to pick which two are the best combination for you, because it's different for everybody. Like, monetary policy is different for every central bank in the world. So I just think this is a useful concept that can extend beyond finance. It's a good way to assess certain trade-offs, because this triangle appears, believe me, in a lot of other things in your life decisions. So, little life lesson, but let's get back to diving down in the iceberg of finance. The Rothschild family comes up in a lot of financial conspiracy theories because they are one of the wealthiest families of all time. They were widespread throughout Europe. They had banking houses in London and Austria and France, and they eventually expanded to have some presence in the United States as well, and Spain, and to a lesser extent Germany. And they were able to be one of the first global banking conglomerates because they kept their money in the family and they had connections all over the place to do that. They made money originally through the government bond market and financing governments, particularly wars, and they would finance both sides of them. There's an apocryphal story, which I'm not sure if it's entirely true or not, but my guess is that there is a kernel of truth to it, that the Rothschilds had an advantage in getting news faster than the rest of the world due to their fleet and of couriers, like through boats and personal deliveries. So they found out that Britain won the Battle of Waterloo before the rest of the city of London did. So they made up rumors that the English lost, bought a bunch of pound and sterling and got sterling-backed government bonds, and then when the real news of Waterloo came in, they came in value, and Nathan Rothschild made a fortune. Yeah, I mean, why don't people like the thing is because the Rothschilds have had so much financial success and are pretty secretive and private people. There's a lot of conspiracy theories that they're generally up to no good. Some of it may just be rooted in class envy or whatever insert reason that typically people have conspiracy theories. I'm not really sure which ones are true or not. I mean, my knowledge of the Rothschilds is really only up to, say, about the mid-19th century. I read Neil Ferguson's book about the origins of the Rothschild family, part 1. I never really got into part 2. And it is kind of strange that you don't really hear from them these days. But that kind of goes back to my theory on old money nobility, which we're going to get to in the very bottom of this iceberg, because it's not just the Rothschild. They're actually relatively new money for European standards, at least. So that's kind of my take on the Rothschilds. Like, they were great art collectors and wine collectors, and now they're more involved in philanthropy and investments more than traditional banking. But yeah, I mean, where is all the Rothschild money? Did it really all get split so many ways that they're not as wealthy anymore? And if spendthrifts in the family can do that, or is there another story deeper here with what happened to the Rothschild money, and how much influence do they really still have in global affairs? I know they like to keep a low profile, especially after World War II, where the Austrian house got completely wrecked due to the Third Reich. But yeah, that's my thoughts on the Rothschilds. The next one is survivorship bias. This is another dirty secret of finance, and I did a YouTube video on this. It's basically, if you look at the performance of investment firms over long periods and the probabilities of people beating a market benchmark for a certain amount of time or a certain amount of years in a row, it kind of lines up well with the amount of people who are the exceptional winners. Like, say for example, like the probability of beating the market in a given year is 15%, and I think it's probably higher than that, but I'm just trying to be conservative. And so if you basically have that and you do that for 10 years out, the probability of being in the market for 10 years in a row is 0.00006, which is 1 out of, I probably add a few zeros, 173 million people. But I think, again, it's probably higher than 50%. Let's say it's a single elimination tournament like college basketball, okay? And it's 1 out of 2. So half the people beat the market average and half the people lose. And so if you do that over a 10-year period, like, you still have 1 out of 1,000 people competing who's going to beat the market 10 years in a row. There are 10,000 hedge funds in the United States alone, and several other mutual funds and other investment vehicles and family offices. So you're going to get, just based on pure probability, a decent handful of well-performing firms, just on raw probabilities, who are going to outperform the target benchmark, and every year. And I'm using this one in case is the industry average, so it is like it's 50% beat it, the median 50% don't. And I'm not saying that people are bad at their jobs and the market's efficient, because if I did, I wouldn't work in my industry. However, you have to look, you can't just, and this is not just for finance, it's just for life in general. Just because somebody is successful doesn't mean that everything they did is automatically the best strategy to go, because I use the example of people waking up at 5 in the morning every day. It's a common trope that if you're going to be successful, you wake up at 5 in the morning every day, because like you have to see a few billionaires who do that. But what about all the other people who wake up at 5 in the morning, who just have normal, boring jobs, or who are poor or didn't make it? You don't really hear about those. And that's what survivorship bias is about, because it started this idea of planes in World War II, and people looked at, oh, the ones that came back all had holes in their wings, and so therefore we need to reinforce the wings, because it must be the ones who didn't also must have got shot in the wings. But really, there was no planes that got shot like in the nose by the engine that came back at all. So you have to look at what people did wrong, and avoid that is just as important, if more important, than what people did right, and what the successful actions successful people took. You want to look at the divergence there. A good example is avoiding Taleb's turkey, as I talked about in the last video. That's a killer for a lot of investment managers. Mansa Musa is one of the most interesting stories of any medieval monarch in the world. He was the emperor of the Malian Empire, which is now in the Sahel region of West Africa, which is not the same exact borders as the current country of Mali, but the part of the current country of Mali was in its empire back then. And Mansa Musa was known for being one of the richest men of all time, because his empire was very abundant in gold mines. In fact, they traded gold pound for pound with salt. That's how much gold there was at the time, and how much they demanded salt. And Mansa Musa came to power. It's a funny story. I'm not really sure, again, if it's entirely true or not, but his father or his predecessor wanted to go see what was on the other side of the Atlantic and try to make it a voyage to whatever was there, which is a new world. Now we know it's North and South America, but they didn't know that back then. And so he got on a boat and brought a bunch of treasure and supplies to last for years, sailed off, and it was never heard from again. And he let Mansa Musa be the steward of his kingdom. And since he didn't come back for a long time, Mansa Musa just took the throne. And that's how he became in power. I just thought that's a really funny story. And then as part of his reign, he went to Mecca for his pilgrimage, because Mansa Musa was Muslim, and that was a mostly predominantly Muslim kingdom that he ruled. And he had so much gold, and he spent so lavishly, that when he stopped in Egypt, he caused borderline hyperinflation for a decade and messed up the Egyptian economy, because he just flooded the gold supply with all the money he had. And this shows you just kind of how crazy rich this guy was. And several other economies along the way in these various Islamic cities had similar effects. And yeah, that's the story of Mansa Musa, possibly the richest man of all time. We don't really know how much gold he actually had, how much property he had, but he is enough to mess up the economy of Egypt, and enough that his dad was able to sail off with a giant fleet of ships with years of supply to explore the unknown ocean. Next is Volmageddon, which I kind of talked about with Taleb's Turkey. This was in February 2018 when the VIX doubled overnight because there was a raid on a lot of these low volatility ETFs, and they went from having a sizable value to near zero overnight because they got margin called. Like if you're doing something that shorts the VIX and it's double short the VIX and the VIX goes up 50%, you lose 100% equity in theory with these levered ETFs. And it caused the VIX in 2018 to spike from low double digits or low, like not even in the teens, to 50 within a couple weeks, with most of that spike being on a Monday. And vol came back down quickly after that, but because there was no systemic economic collapse, it was more just the VIX people, just the investment community, got overly short vol and using a bunch of option selling strategies in ways that were not the most risk prudent because they look good on Sharpe ratios, and a lot of people got hurt. Yeah, that's Volmageddon. Volmageddon can happen anytime. It doesn't need to be a world-ending catalyst. There was no world-ending catalyst. There's too many people shorting volatility. Next, I'm going to talk about is Davos. Davos refers to the World Economic Forum. It's this meeting every January where a lot of the business leaders, finance ministers, and politicians and wealthy people go meet to decide their thoughts on what's going on in the global economy and what they should do about it. Leads to a lot of conspiracy theories because the World Economic Forum is it's very exclusive. They tend to have kind of very elitist beliefs. They are the best fodder for conspiracy theories because the stuff that they propose in their policy papers is outright ridiculous. You've had articles on the World Economic Forum saying, I own nothing, I have no privacy, and I'm happy in a world where basically you have to rent out your living room for office space to supplement your basic income, and you don't even own the clothes on your back, and everybody in a city just rents everything and rents out everything, and if people are happy about that, that's like, it sounds like to me, no personal freedom whatsoever. You can't have personal or economic freedom without ownership. But that's one example. They've also pitched things such as eating bugs, and they've been way out there and early in a lot of socially liberal or anti-natalist family trends. So they're not even really conspiracy because I'll put links to all of these in the description because they actually propose these stuff and written in policy papers where I think it gets, and Klaus Schwab, who's the founder of it, doesn't help himself looking like a real life version of Blofeld from James Bond movies and proposing all this like totalitarian top down elite know better than you running the world type policies all the time. You're asking for Alex Jones to go after you. It's really my take on it. Maybe that's what they were trying to do, is distract people. I don't really support a lot of what these people propose. I think it's kind of crazy, but they have this private meeting in Davos, Switzerland, which is about less than 50 miles away from where my grandma grew up in Switzerland. They talk about stuff both in private and public. Like, there's over 3,000 participants joined the last one that they had, with the most attendees being from the US, 674, the UK at second at 270, and the Swiss at 159 at third. Most of the participants are men and over 50, which makes sense because the average billionaire is 59 years old and is more likely to be a man. But there are women and minorities there too. Like, notable people who've attended in the past are George Soros, Xi Jinping, Donald Trump, then Christine Lagarde, and various other presidents, prime ministers, and central bank heads, and corporate leaders too. Yeah, that it's really, I think, it's a lot of these people talk among themselves, and maybe they kind of build their own little intellectual bubble, which has them miss certain trends, which might be another critique of Davos, is that it's not very representative of the world, and not from a typical diversity means, but more in terms of like class and line of work. Like, if it's a bunch of billionaires, politicians, and their friends, they're not very representative of the broad population of the world. Some people think they actually have power to make policy, and there's a lot of backroom deals that go on these World Economic Forums to push the agenda written in their policy papers. I haven't seen any proof of that, but I'm open-minded to the possibility. Davos man is like now a slur for somebody who is a global elite who thinks themselves international citizen of the world, has really no tie to their native country and have no needs for national loyalty and just prefer their own self-interests and their clique more than what's good for their actual people. I think a lot of this sentiment, whether it's caused by the World Economic Forum or just general social isolation of the upper classes, has led to a lot of the populist resentment that we've seen in the last decade. And then, yeah, there's a whole big rabbit hole with Davos, but basically it's just a once a year January meeting where the elite go to discuss what the elite want to discuss and figure how they think they can make the world better, but probably for their own interests more than better for everybody as a whole. Next, I'm going to talk about in this iceberg is, now we're done with Davos, is financial repression. Financial repression is the idea that a government will deliberately hold down real interest rates to pay down debt or to finance government expansion or projects, or such as a war, or a massive infrastructure build, or to pay down debt from a war or a massive infrastructure build, or increasing the welfare state, or whatever the reason is. It varies. Example of this was when the Fed basically pegged the yield curve at 2.5% between 1940s, like in the late 40s, early 50s, whereas inflation was much higher than that. So that's a way to get down the real debt to GDP over a 10-year period of time. You can argue that's what happened from 2009 to 2015, when inflation was consistently around 1.5 to 2.5%, but you had interest rates at zero for almost 8 years effectively. And that was arguably financial repression, because it allowed governments to continue to maintain their spending trajectories and deficits without, and as long as they kept them at a reasonable percentage of GDP, the real debt to GDP would still drop. This was also the way Asia built itself up post-World War II, is that they held interest rates well below inflation, especially for loans that were dedicated to building out infrastructure and the manufacturing base of these countries. And that's how the government was able to indirectly extract private wealth to build out its country. And I think it's a very popular tool, and it's going to continue to become a popular tool among governments because taxes are, or at least on income taxes rates, are already very high in Western countries, and it's a very hard sell, especially if you're trying to raise taxes for people who say make less than $400,000 a year, which is what you need to do, because even if you taxed all the billionaires, everything, that would not be enough to pay down the debts or really make a long-term drop in the bucket given how high deficit spendings are. So you have to find a way to tax the general public in a politically feasible way. And financial repression is the easiest because it doesn't require voter approval, and most people don't even know what's going on. So I think financial repression has been pretty much ongoing since 2009 in the United States. And it's been the same in most countries in the world, except for those who struggle with historically high inflation. And that's kind of my thoughts on it. I think it's going to keep going. It means you have bond markets are not going to offer the best real returns. And it also makes the economy more fragile because so many people have borrowed money on the expectation on these interest rates staying as low as they have been for as long as they have been, that every time you get a flirtation of real interest rates going positive, like the last time we did was Q4 2018, the market gets in a fit and you have fears of defaults and bankruptcies and all that because it's created this, it's back to the whole zombie loop again, where you have companies, individuals, and businesses and governments who basically can refinance, but to pay their interest, but not to pay their principal. And his interest rates are so low that interest expense is down. So the fact that they're in this situation means that if interest rates materially rise, and because they're such a low base, a move from 1% to 2% It's a doubling of interest rates. Whereas it moved from 5% to 6% is only a 20% increase. So the magnitude on a percentage basis is much higher to get out of it. So that's what it makes it. It's kind of like a roach motel if you're not careful with it. And ultimately, it really won't change unless inflation really does rise enough to force the hands of central banks to end the financial repression, because too many of the powers that be benefit from it, and more people in developed countries, particularly the United States, are net debtors versus net creditors, especially our government. Next is the Crassus Fire Department. This is a story about Crassus, who was the most wealthiest man in ancient Rome. He inherited a small estate, relatively speaking, for a patrician. It's about $8 million in today's money. And he used his entrepreneurial guile to build the largest fortune in Rome and eventually become an influential political figure, a consul in his own right. And he had an attempted career at a military generalship, and his pride took him down with a failed invasion of Parthia, which is how he got killed. He was known for his avarice, particularly, and the reason why in the Iceberg I refer to it as the Crassus Fire Department is because his most, I'd say, unethical scheme was that he created some of the first private fire departments, and whether it was an arson or an accidental burning would happen, and some would argue maybe he did these intentionally to get property. The fire department would come, but they would not put out the fire like a normal fire department would be. Like and like what libertarians propose as a private fire department is that you pay for it like car insurance or something. You pay for fire insurance, and if you have fire insurance and your house catches on fire, the fire department will come and take it out. A private fire, but that's not what Crassus did. No, he would come. His fire department would come and say, "Hey, we will put out the fire in your house if you sell it to us for below market value." If they didn't really have homeowners insurance back then, so like if your house burned down, you basically lost all your value, or we'll let it burn down, and you'll have to sell it. You'll be destitute and have to sell it on the auction or get it foreclosed on. Or I don't even know if they had foreclosures in ancient Rome, to be honest with you, but they'll lose the house for next to nothing if they let it burn. So the people are now in a hostage situation, and either he picks it up, the burnt property on auction, or he will buy it off them at a discounted price in exchange for them for putting out the fire. And this is how Crassus built a massive real estate fortune. Yeah. Archegos and Ark. Basically, this is the story. Archegos was a family office by Bill Huang, who got overly leveraged tech companies 5-1. And he lost $50 billion for banks because a lot of these stocks moved down on news of secondary. How does it connect to Cathie Wood and her ARK fund? Well, according to reports, and actually I'll put the link into this description. I think it was Reuters or Bloomberg who first reported it, that he was one of the seed investors for Cathie Wood's active ETFs. Which, I mean, people think, oh yeah, since he blew up, there's something shady going on. No, I mean, it's hard to raise money, and they happened to go to the same church together in New Jersey, so they knew each other. And so, yeah, I mean, it's a seed investor. Just because your seed investor is a guy who'd blow up his family office many years later, and Bill Huang had some other history in his past, that like in terms of like with regulatory problems, but yeah, I mean, she was able to run with it and has built a business. I'm not really a big fan of her approach to investing, but that's nothing really there's really nothing ethically, I think, problem with what's going on. And I don't really think it's really a movie market, but I just think it's a strange coincidence that two of what are known as like the most aggressive mutual fund, well, not mutual fund because Archegos not mutual family office, the more aggressive growth/tech investors happen to have such a close ties. The next one is China's House of Cards. It's really the idea that I briefly hinted at this in the last Iceberg, is that a lot of China's economic data isn't real. Like, they've been exaggerating their GDP data. They've maybe underestimating inflation. Their debt levels are maybe way worse or way higher than they believed. And a lot of their GDP growth products are building apartment buildings that never get filled. And there's a lot of incentives on the provincial governments and local governments to do useless projects to boost the GDP number because they were compensated and graded based on how well their performance was on that. And as a result, due to all of these perverse incentives, and China wanted to look like they're going to become the biggest, baddest economy real soon, that a lot of people think that a lot of the economic data is not real. There's actually a whole conspiracy out there that China's population is a fraction of what they say it is because of the limited number of, say, mobile phone plans you would expect for a country its size, or power use, or other things like that. Either the economy's not doing as well as people think, or there's less people there than people think. One or the other. I mean, I do think China's economy has grown a lot over the last several decades, because you wouldn't see transformations of their cities or the flow of Chinese capital overseas or the growing influence of the country. And the fact that they've replaced the U.S. the main exporter to over 100 countries around the world. So it's not like they're complete mirage in this, but there is an idea out there that China is a lot smaller economically and has a lot less heft than their government claims to be, and that's probably true. We just don't know what the magnitude of that is. The same thing with their COVID cases. That's a whole another story as well. The next one is George Soros. Speaking of conspiracies and of the elites, George Soros comes up a lot. He is known as one of the greatest macro traders of all time, and also one of the biggest funders of progressive causes through the Open Society. I have mixed views on George Soros because, one, I respect him for his professional capabilities and his great instincts as a trader. On the other side, I really don't particularly like the Open Society's vision or values. It's not really in line with my personal beliefs. So I think a lot of people get overly political about how they view him. Either he's like literally the devil incarnate, or he's like this great benefactor for progressive good. I mean, neither of those are true. Would I say that George Soros is a paragon of virtue? No. Would I say that the Open Society, if you read his book, Soros on Soros, which I do recommend if you want like an idea of what this guy's about, he generally wants to break down social barriers, cultural barriers to commerce and to transactions, and to make every human interaction more transactional in nature. Like, he doesn't like the idea that you would, say, for example, sell your house to your son or daughter at a discount because they're family, or that you have loyalties to things such as your nationhood, your religion, your friends, your family, and not to just whoever the highest bidder is. And you could see why that rubs people all the wrong way. It also somewhat synthesizes with progressive causes, because a lot of them want to break down stigmas and cultural barriers against what they consider to be oppressed minorities, or reduce the power of what the left considers to be outdated institutions such as organized religion. But at the same time, there's a lot of people who like this type of stuff, and people have in-group preferences, and people are human. They don't want to base everything on a transaction. Like, what kind of friendship is it if you have to pay to spend time with them at all times? Or that they only value you because of your market value? That's a very sad world to live in, which is what's my main critique of Soros' ideology. As a trader, I think you can learn more about him than his personal life. I think he was the one who successfully broke the pound in the 90s. He has the concept of reflexivity, which is the idea that trending price action creates the fundamentals that reinforce the trending price action, and it keeps going until there's a catalyst that breaks it. Like, say, for example, a currency is weakening. It's trending down, and because the currency is weakening, people have more fears. They sell the currency, it weakens more. And because the currency weakens more, it hurts the fiscal balance of the government, or their trade balance, because they have trade deficit and it relies on imports. And so therefore the fundamentals have gotten worse because of the speculative attack on the currency, or just the fact that there's a random price fluctuation. Man, it doesn't have to be a speculative attack. And because of these fears now of a trade deficit problem and a twin deficit problem, then you've got the currency weakens more and it becomes a downward spiral. And it's not just currencies. This applies to stocks. Like, say for example, like the AMC is a great example of this. AMC was in trouble because people aren't going to movies anymore because of COVID and digital delivery. But then there was a bunch of Redditors who bid up AMC, and because they bid up AMC, the stock price went up. That means their debt levels went down. They were able to issue stock to pay down some of their debt and have cash to survive. And so now therefore the company has a higher intrinsic value than it would have otherwise because the stock price went up, which causes the stock price to go up even more. There's a lot of other dynamics with AMC, such as weird short squeezes and meme-ish stuff, but like this applies to other companies too. Just say like there's a random widget maker who has a lot of debt, but and it hasn't been doing so well lately. But some investors believe them have potential that their products can become trendy again. So they buy. That causes the stock to trend higher. Their debt to equity ratio drops as a result. Therefore, their balance sheet looks better. They're like, oh, maybe they're not such in trouble. The stock's recovering and their debt levels are down. And so that encourages more people to buy, which improves the stock's relative capital position again. And then the cycle repeats. And then the stock price higher gets some more attention. And so more people buy the product because they're like, oh, wow, this company actually does have a cool product. They must have, because their stock going up. They must be doing something right. And it creates this beneficial feedback loop. And it can work the other way too, like the example of the currency. So that's probably the most valuable lesson. I just summarized the most important part of George Soros' book, The Alchemy of Finance. George Soros, again, he's a controversial figure. I don't like a lot of his personal beliefs, but I think his market beliefs are insightful. And the lesson of George Soros is that it's the importance of splitting somebody's ideas on one thing or their usefulness on another thing. Like, you can learn from people who have completely different political views than you or totally different religious views from you, even if you don't have to personally like them or respect them either. It's kind of a weird conundrum, and George Soros kind of is the epitome of that for me. The Bitcoin origin myth is the idea that Bitcoin was created and disclosed in a white paper written by an anonymous coder named Satoshi Nakamoto, which people still don't know who he is till this day. There's rumors about his identity, but it's not well known still at this point who it is, and I don't even know. It'll be a big news story. For some people think that there is no Satoshi, there's just a bunch of coders who just wanted to be anonymous. Or, yeah, it's just like, and the fact that he has this whale that holds all this Bitcoin and won't sell is what provides a lot of faith in the currency. And Bitcoin, I think, honestly, is more of an act of faith. This origin story is very common like a lot of other religions. It's like, yeah, some unknown guy created it. He has a good story behind it. People believe in it. And except the really difference between Bitcoin and a religion is that it's a financial product. And people put their money behind it. And the faith in it is correlated to how much the crypto moves up or down. And a lot of the people, like you should see this funny video I saw, I think was done by CoffeeZilla, shows like the Bitcoin conference in Miami, and a lot of the language used, some of these speeches, sounds like a pastor in a mega church. It's very faith based, because it really is. It's either you have faith that Bitcoin is going to be the replacement to the current monetary system, and the current one's going to break down. It has an apocalyptic vision, which is also like a religion too, in a way. But yeah, it's just kind of funny that all the other cryptocurrencies, they have clear founders, but that's also the appeal of Bitcoin, is that since there is no one person who controls it, it's completely decentralized, then as a result, the whims of one coder or founder can't wreck it or rig the crypto in favor of themselves, which just makes the appeal of Bitcoin and why people believe in it so much, is because it's hard to taint. Hello, everybody, and welcome to the Iceberg of Finance Part 6. Things are going to be getting real deep and kind of janky now, so let's get on with the show. Most people know Hillary Clinton for being the Democratic presidential candidate in the 2016 election, being a two-term senator from New York, First Lady to Bill Clinton, as well as a former Secretary of State. But what's not as well known is that she apparently also is one of the greatest commodity traders of all time. Yeah, that was kind of a curveball. In the 1970s, Hillary Clinton, when she was a First Lady of Arkansas, engaged in a series of cattle futures trades. She turned about $1,000 into nearly $100K, or about $356,000 in today's money, over a 10-month period. I mean, with that kind of return, it'd make even the George Soroses and the Warren Buffetts of the world blush. And the interesting thing about this, too, is that she did this primarily short-selling cattle, even though during this period, the cattle market was in a strong bullish uptrend. So how do you make so much money going against the trend of the market with somebody who doesn't really have any experience in commodity trading? He really hasn't done any since. It's kind of suspicious, and it's controversial due to her personal ties with top people at Tyson Foods, which is one of the biggest meat distributors in the country. So if anybody knew about when people are buying and selling cattle, it would be Tyson Foods. And if you just do like the mathematical odds of her success, it would be 1 out of $31 trillion. There were some investigations, but she ended up not being charged of wrongdoing. It became a big piece in the National Review and a subject of conservative political criticism in the mid-90s, 94 and 95. But it's just kind of really odd that somebody who is a career politician who really only traded this time in her life became the greatest cattle trader of all time. What I have to say to you, Hillary, is congratulations. Maybe you can teach the rest of the world your masterful skills on how to manage the supply and demand of the meat market. The next topic I'm going to discuss is Confessions of an Economic Hitman, which is a book written by John Perkins, originally published in 2004. I remember reading this when it was fairly new, when I was in high school, and it really stuck out to me because it explained a lot of why things that you think would not be in the best interest of the U.S. and other major economic powers to do was taking place, such as lending money to insolvent countries, otherwise insolvent countries who have a bad history of paying back. Like the examples that Perkins mentioned in his book were Ecuador and Panama and Nicaragua. And basically his claims is that he worked at a major consulting firm that specialized in international economic relations and foreign aid and that kind of stuff. Is that national security agencies and the World Bank and the IMF strategically overly in debt countries and give them financing for projects that may be good for the country, may be good for the incumbent political regime to keep power, or whatever the reason is, the financing to these countries, and they'd give them an amount of money that is not reasonable to pay back. And they would do this on purpose because the terms of forgiving the loans or not trying to cause the country to default would be that the government of the weaker third world country would do certain policy measures that the creditors would want, like maybe it would be access to oil in the case of Ecuador, or not trying to disrupt the Panama Canal, or not nationalizing the fruit industry, which is the classic banana republic example, where a lot of Central American countries, have Dole and all these major fruit companies, Chiquita, grow a lot of bananas there, and are able to hire people at substandard wages and or not pay taxes or have other favorable political privileges due to outside pressure from the United States government. And basically this book kind of explains what Perkins claims to be the mechanism of how this goes about. And you got a lot of pushback saying, particularly mainstream press, saying that in the State Department, that there's a lack of evidence to corroborate Perkins's claims, and that this is not something that people do, and that basically also a lot of these governments do such a small amount of trade with the United States that it doesn't make sense. Because he also mentions that if a political leader does not comply with the requests of the creditor nation, then they will do political assassinations, which they use the example of the presidents of Ecuador and Panama allegedly were killed in plane crashes or that were staged intentionally because of the owners of the foreign debts of these countries did not like their policy decisions. Both of those combined are less than 1% of American imports and exports. So, I don't think that materiality, especially with the Cold War dominance of the U.S. military, is a viable excuse. But at the same time, is it really that big of an interest that the U.S. government would risk a scandal of regime change and intervening in foreign politics just over a relatively small amount of debt to be paid back? I'm not really sure. When I first read the book, it seemed very compelling to me, but also I maybe was the more conspiratorially minded when I was a teenager. The thing that also, though, that makes this interesting is that China is doing a lot of these similar tactics in its neighboring countries in Asia and Africa. And now you see the Americans accusing China of doing economic hitman type operations, yet the U.S., through the World Bank or the IMF, is super innocent and has never done such a thing. I think that that's kind of hard to believe at the same time. So I highly recommend reading this book. It really makes you think. I think China and the U.S. and a lot of other major powers, the EU, maybe Russia as well, use strategic financial arrangements to achieve political interests without having to conquer a nation. The Rothschilds are actually famous for saying, "Give me a country's banks and I control its government." I don't think that's the exact quote, but that's the general idea. And I think that these type of things go on across the world, especially if you have creditor countries that have a lot of economic pull and desperate debtor countries who would not get financing otherwise. I think it's just more blatant with the Chinese because at least the U.S. makes it look like that there's a reasonable plan of credit worthiness and that it's in the interest of human rights and other positive things, and whereas in China, people know it's a straight resource deal. And then the other difference too is that a lot of the leverage that the Western creditor nations uses to make political and social reforms, such as liberalizing their economies, having a more socially liberal human rights platforms that have to be adopted, whereas China doesn't really care about their domestic affairs. They just want to maximize the amount of resources, particularly oil and minerals, that they can extract, and food that they can extract from the country. Next I'm going to talk about is Swiss banking. Swiss has a reputation for certain goods that they are known for manufacturing. They have great chocolate, including Nestle inventing white chocolate in 1939. They're known for their watches. They're known for their army knives. They're known for their cheese. But Switzerland is most famous in terms of its economic weight is in its banking system. The Swiss banking system really dates back to the early 18th century when wars via the great powers of Europe and the neutrality of Switzerland economically led to a lot of nobility and rulers putting their money in Swiss banks instead of in their own countries and afraid of seizure due to revolution or war or borders changing or any other variables that made their home countries far more risky. And then when it comes to Switzerland, it is still one of the most secret banking places. Like the fact that if somebody wants to find out if you have, and this is assuming for non-Americans, if you want to find out if somebody has money in Switzerland, they will not share those records. They actually codified their Swiss secrecy banks laws in 1934 with a landmark federal law on banking. And then these laws have been able to protect assets of many people. It was originally actually protected people who were persecuted by Nazis, but later a lot of the leadership in the Third Reich put their own money in Swiss bank accounts. So a lot of people argue that a lot of money that was assets that were seized by the Germans during World War II that was put in Swiss bank accounts were never claimed, and that the Swiss banks or government just pocketed it and helped contribute to its wealth. I mean, also Switzerland benefited the fact that it didn't fight in World War II, and so therefore it wasn't completely destroyed and wasn't forced to rebuild like all of its neighboring countries who were combatants in the Second World War. The Swiss Bankers Association estimates that there is 6.5 trillion US dollars in assets in their banking system, or 25% of all global cross-border assets. They have three main hubs for banking activities, which are Geneva for French speakers, Lugano for Italian, and Zurich for German speakers, and really everybody else. And the total banking assets compared to Switzerland's GDP is 467% of their GDP. And in books, movies, popular culture, it's too like if you're a rich person and you automatically have a hidden bank account in Switzerland. That used to be true back in the day, but during the Obama administration, there was a rule called FATCA that was passed. And basically, FATCA changed it so that the IRS has a right to look at any international bank account, no matter what the local bank secrecy rules are. And Switzerland decided to comply with FATCA towards its American clients. And it probably did result in some tax evasion cases by the IRS. And I know that I used to have family and friends who were Americans who had to face a dilemma. Either they would have to disclose their stuff to IRS, or renounce their citizenships. And basically, for an American now, it makes no sense to have a bank account in Switzerland. There's no advantage. And I think that this helped with the popularity of cryptocurrency among the American market because it did offer that transparency, but even that may go away soon. But yeah, bank secrecy there is treated the same way as attorney-client privilege or medical records are treated in other developed countries, and that's kind of the rationale for it. But if you're American, due to FATCA, you don't really get to have a secret bank account. So a lot of banks now just reject American customers due to not wanting to deal with FATCA compliance. And again, but for other bank accounts, the countries, there's still plenty of leaders. It's actually pretty famous, having a reputation of having dictators from autocratic countries or people who would earn that money in a way that would not be legal or ethically just in their home country, would create a Swiss bank account to hide their transparency. Like, I wouldn't be surprised, say, for example, if Vladimir Putin had 10 or 100 billion dollars in Swiss bank accounts, because it's hard to track. But in general, a lot of the mystique around Swiss bank accounts was a little bit overrated and is actually completely meaningless in America. In terms of banks, there's two that kind of dominate the markets, which are UBS and Credit Suisse, which are both major publicly traded money center banks. They account for 50% of all deposits in Switzerland and have branches all over the world. They also have several private banks all over the place too for wealth management and other needs. The tax rates in some of the cantons are particularly low, particularly Zug, which is a canton south of Zurich, which has no canton tax and only pays 12% income tax. So it's a popular place to domicile business, and it's also one of the highest cost of living in the world because of that. Like Switzerland, unlike the US, where the federal taxes are the bulk of your tax burden, states are a much smaller amount. It's the reverse there, where you have the federal tax is 12%, and the state tax ranges, cantonal tax ranges anywhere from 0 in Zug to 29% in Zurich. So where you live within Switzerland has a big impact on that. So, yeah, the result of having such a banking system, not just a reputation for secrecy, but also just a reputation of fair dealing and trustworthiness and international credibility, it has resulted in Switzerland having the highest gross domestic product of any country of its population or higher. Switzerland is about 8 million people, and it's got a GDP per capita of $95,000 a year. Adjusted for cost of living, though, that's much lower. It's probably closer to, say, like what the U.S. would be, say, like maybe a little more, $60,000 a year. But for given how small it is and how it's landlocked, that is very impressive. And again, I'm biased. I'm half Swiss. I'm a Swiss citizen. So I'm not going to really trash my homeland, motherland, I guess, to my mother's side of the family is from Switzerland. But yeah, in general, that's my thoughts on the Swiss banking. There is secrecy stuff going on, but it's not as, I don't know, James Bond-esque as they talk about in the media. And on top of that, if you're American, because next we're going to talk about the Great Reset. Now, the Great Reset is really this idea coming from our favorite people at the World Economic Forum, which I talked about on level 5 that we done the Iceberg, and the kind of the spokesman for this is Prince Charles of the UK. It's basically a theme of rebuilding society in a more sustainable way following the COVID-19 pandemic. They want to create conditions for a more stakeholder economy and emphasize ESG measures and a fourth industrial revolution for the public good and make things more green and smarter and the economy more equal and fair. I mean, those all sound like great platitudes, and it's then linked to a lot of conspiracy theories as well because of its name. The Great Reset does, I mean, these guys cannot help themselves. As I mentioned in my critique of the World Economic Forum in part 5 of this series, the Great Reset doesn't really help matters, calling it that. It's like you're implying that there is some dark conspiracy to this, and you're just asking for like that type of criticism just with the name, and also with some of the other stuff I've mentioned in part 5, such as the ideas of the bug eating and the I have no property, and overemphasizing a far left social agenda that is not very popular in not only the United States, but many of the more socially conservative parts of the emerging world. So you're not, again, it's not doing, but I mean, at the same time, a lot of these conspiracy theories surrounding it aren't particularly true either. That it ties all the really crazy stuff that I cannot say, or this video will get taken down. You know this group, and then they throw that all in there and say it's all part of the Great Reset, and it's or the New World Order type stuff too is thrown in here too. Do I think that the people at the World Economic Forum would like to reorganize things in a way that redistributes global wealth and opportunity to them? Yeah. Do you think that there are ways that they'll do in their power to try to do that? Possibly. Do they have enough power alone to do that. That's where I highly doubt it. I think they have the motive, and there is a strategy, but my question is, I just am skeptical of the ability of such a small, lack of a better term, cabal of a few wealthy people to be able to do all this in secret and basically create their open society-esque utopia and without any sort of pushback, or be able to just steamroll all the pushback as if we lived in a pure top-down global autocracy. So yeah, I think that they probably don't. They probably have some self-serving idea, and their criticism is probably true on that front. And it's, again, a lot of the World Economic Forum is to wealthy people to make it look like they care. But at the same time, I question a lot of the crazy conspiracy theories to describe this as a great communist takeover plan. I'm definitely not a fan of communist takeover plans, and there are probably other ways that if that's going to happen, it'd be not through the Great Reset. So that's my thoughts on this topic. Next, we're going to talk about rogue traders. Basically, a rogue trader is an employee at a major bank. It's usually a big bank, could also be at a buy-side firm, that makes unapproved financial transactions and often covers up the tracks by mismarking their securities. This has happened several times in the last 3 decades. Mainly happens is that the trader gets themselves into a hole and they don't want to get fired or not miss out on a bonus because of it, and so they take unnecessary risks to try to make the money back, and then it backfires on them again. So yeah, it's kind of less likely to happen now, as a lot of says digital records, and compliance has changed that now every institutional sales trader or somebody who has the potential to have a role that involves rogue trading now has to take 2 straight weeks off at minimum per year, so that they can't be constantly covering their tracks, and their supervisors or whoever takes over for them will see this happening. I mean, the most famous example of this is the movie Rogue Trader, which is based off of the story of Nick Leeson, who blew up Barings Bank by having a $1.3 billion loss in 1995 trading Nikkei futures. The most recent big example of this is Jerome Kerviel, who lost $7 billion for Societe Generale trading European stock futures. And there's been several other notable ones of over $100 million throughout the last 30 years, about 10 of them. I don't really think there's anything that crazy. I mean, people say like these are evidence of rigging markets, but it's usually just people who don't know, who either like just take too much risk for some reason, or there are people who try to basically do one crime to cover up another. It's kind of like the trading version of Nixon's Watergate. Hello and welcome to the Iceberg of Finance Part 7. Thank you for joining me this far into the journey. Now we're kind of getting into some of the more outright conspiratorial aspects of finance, and I'm going to try to suss out which ones have some basis behind them and which ones are just plain crazy and out in left field. And then after this we have part 8, and then we're going to move on to more of our usual Analyzing Finance with Nick content. But if you like this series, please tell me, and if I ever get to 10,000 plus subscribers, I will do a second Iceberg of Finance. But now let's get on with the topics. This next one I'm going to talk about is the Barter Myth, which is this idea that if money disappeared tomorrow, everybody would go back to bartering. And before the invention of currency, the way that people exchange goods was via barter. For those who aren't familiar with the concept of bartering, it's basically the idea if I, for example, wanted to get a pair of shoes, instead of being able to pay $100 for those shoes, I would have to trade you 12 cartons of eggs, or like 12 dozen would be 144 eggs. And so, since there is no currency, which is kind of a standard unit of account that people can use to buy other goods, you would have to directly offer that. Because say the shoe salesman doesn't need what I say, for example, I'm a candle maker, and the cobbler doesn't need candles. He only wants eggs. And so therefore, I would have to find somebody who I had trade my egg farmer and trade my candles for his eggs, and then go to the cobbler and trade the eggs for the shoes. You can see how this would be really inefficient and complicated, and this is what the theory was, is people thought would do direct exchange like that, where it was not really the case. That's why it's called the Barter Myth. And our first idea I got in this book was called Debt the First 5,000 Years by David Graeber, which we'll talk about at the very bottom of this iceberg. And based on what his research and other economists that I've read about this, is that it's not that barter was first for currency. It's just that everybody just exchanged debt or IOUs. So, like, instead of, say, for example, the shoe guy doesn't need a candle from me, so instead he'd give me the pair of shoes, and if I ever needed something from him, if he ever needed candles from me, I would have to owe it to him at a future point, or a future when he would have to come and collect, and I'd pay it back. Or it could be denominated in wheat or eggs or whatever. That's that whenever I am able to exchange my goods and services for that, I will pay him. And basically, so it was kind of a giant bank. Everybody was kind of their own individual bank, in a sense. This example, which I have to give credit to Patrick Boyle on this, was the bank strike in Ireland in the 70s, where basically people would write checks and not be able to cash them, so they would just exchange future checks to each other on an honor system. And the old debt system, since there was no things such as credit scores or national records of people's purchases, the only way that people would lend you money and do these agreements is if they knew you. And villages were much smaller back then in towns and rural communities, so people did know you, and so it had your own personal trust and honor was heavily valued back then. And so if you were known to be a dishonorable person who didn't pay back your debt, sorry, you're not going to buy any food. This is where there's the evolutionary perspective and the religious perspective of the importance of honesty and integrity, which I think are important on their own individual merits, but from an economic perspective, this was the original ancient civilization reason why they were so important, because pretty much every sort of economic transaction was dependent on the trustworthiness and the personal honor that people in the society have, and why honor culture does remain stronger now in less economically developed and less technologically advanced societies, because that's the only way you can verify them. And as we've advanced in technology and the financial system has gotten more sophisticated, it's gone always more from trust-based to decentralized, non-trust based systems. Like the whole appeal for cryptocurrencies is that you don't have to trust a bank or a counterparty. But at the same time, people, I think that one of the flaws of 21st century millennial thinking is that a lot of people don't undervalue the importance of trust and relationships, whether in building a business or just functioning as a member of of society, and how your life can be a lot easier if you develop credibility, whether it's on your workplace or your town or your school or whatever, as an honorable person. That actually still means something, even in a world that's trying to remove trust out of the equation in any way they can. But unless we come all digital automatons who never talk to anybody in person anymore, then I think that we can learn something from the barter myth and about the importance of trust in society. about Joseph Kennedy Sr., who was the father of John F. Kennedy, president, RFK, Robert Kennedy, his brother, who was former Attorney General, and Senator Ted Kennedy. And the story why he's in the iceberg of finance is how he made his money primarily through financial speculation. In the 20s, he made a fortune in trading stocks, commodity futures, and he also, on top of that, was one of the most notable short sellers during the 1929 crash. And he made a lot of money shorting stocks in 1929. By 1929, before the crash, his fortune was $4 million, in terms of $60 million today's money. By 1935, in the heart of the Great Depression, his wealth had increased to $180 million, or $3.4 billion today. So it's interesting that one of the most famous political dynasties in the history of the United States of America was made on the backs of a short seller. And short sellers are vilified and people hate them so much, yet our most beloved president, I'm not saying he's my favorite president, but one of the most beloved presidents in the history of America was the son of a speculator who financed his children's political ambitions through money made short selling. And there's a lot of stuff was before the advent of the SEC and a lot of the other regulations that we now have in the securities market. So it is questionable, like in today's era, how legal some of the stuff he did would have been, like such as bear raids, or tactics that would be considered insider trading and market manipulation by today's standards, such as brokerage firm in the 20s. He later would diversify this money into other assets, such as in the real estate, the shipping industry, and in the movie theaters as well. So a lot of people like to think that his money was made by the bootlegging, but there really is no evidence to truly confirm that. In fact, really, his money was made through short selling. And it's also kind of ironic because of the way he acquired his wealth, is that he became the SEC chairman. I think the first SEC chairman in its history in 1934, and did that for a year. I could see why FDR would put him there, not just because he was a prominent supporter, but also was because like the SEC's job is to regulate and clean up the financial industry, and somebody who would know about this is a participant. So he would actually probably be the right guy, by that logic, to pick to help get the SEC off the ground. So, yeah, that's the story of the Kennedy family and where their money came from. It's a lot more linked to financial markets than people believe. 14 up, 14 down comes from a concept from economist Philip Anderson, who is noteworthy for his book, The Secret Life of Real Estate and Banking, which I highly recommend, which shows that real estate historically goes in patterns that average 14 years of upmarket followed by a 4-year crash. And with the exception of the post-World War II boom, which had some delays due to just the general rebuilding of the global economy, this pattern has held up extremely well in Anglosphere countries, especially the United States. Like, I'll attach a link to an image of Chicago real estate basically since the 1830s, and this pattern has been remarkably robust and has continued to do so. There's a lot of theories on why this works due to just people's comfort with credit, but a lot of it comes down to the fact that most professionals in the real estate business or speculators usually do not have a career that lasts long enough to cover 2 full 18-year cycles or 36 years. Especially today, where the average person changes jobs or careers multiple times in a decade. There's not that many people who last 36 years in any industry, particularly as one is highly speculative and a lot of leverage as real estate. And so they say everybody who's remembered to live through two whole cycles in the past is probably no longer in the game. And that's my theory on why it keeps working. And I have to give credit to that again to Philip Anderson, who I've had direct conversations with on this in a previous discussion with my clients on the future of the real estate market. But yeah, I think this concept is fairly interesting. It's these similar collections of debt and supply relative shortfalls and surpluses and demographics, and they all intersect to create a surprisingly predictive pattern for real estate markets. I think also why it's more effective in the Anglospheres, because those cultures are more comfortable with speculating for appreciation, whereas other countries, maybe such as Germany or Japan, have more of a history of just saving money in the bank and just are less tolerant of volatility, whether it's from their financial markets or from their views on risky behaviors in the business world, such as entrepreneurship. And the first one we're going to talk about is the City of London. The City of London is not what you think of as the greater London area. In fact, there's a small 1.1 square mile area known as the City of London, which is operated by a separate corporation from the rest of the UK called the City of London Corporation. And it consists of the land that is the original territory that was the Roman city of Londonium. Today, the City of London has a lot of major historical and tourist sites, such as the Museum of London, the St. Paul's Cathedral, the Bank of England. Several major banks are headquartered there. The Gherkin Tower is there, and just outside the limits are the London Bridge and the Tower of London. The City of London often shows up in conspiracy theories because of its unique jurisdictional status. It would be kind of like, say, if downtown Los Angeles was its own county versus the rest of the LA County, or even maybe it's somewhere in between that and say like that DC status where it's kind of its own thing and it's not part of either the state of Maryland or Virginia. And it brings a lot of conspiracies of claims that the City of London is not under the sovereign jurisdiction of the UK, and that technically the Queen does require, from at least a ceremonial manner, permission to enter the City of London. In fact, Westminster is where Westminster Abbey is, and Buckingham Palace and all that was actually started as a competing city to the City of London back when William the Conqueror came to the UK in the 11th century. The other thing it is kind of known for is controversially being called a tax haven, even though the tax system is the same as the most of the UK, except they have their own municipal level taxes versus the rest of Greater London. But what is different is that they are known for having a reputation of bank secrecy. And so a lot of money from various parts in the world and various banks like being operating out there because of the transparency laws are different than the rest of the United Kingdom and is more comparable to a place like Luxembourg or Switzerland. In fact, really the funny thing is that even though London is in the heart of one of the biggest, most important cities in the world, itself is the third smallest municipality in the United Kingdom, and it only has 9,000 people. And the other thing that makes the City of London unique, which is also makes it conspiracy thoughter, is that not only people are allowed to vote, and they have their separate city councilmen, and one of the few places that still use aldermen in the UK, but they allow businesses as well as individuals to vote. And so when you have corporations having the right to vote, that raises a lot of eyebrows. And that is really the City of London. It's just the historical center of London, which has some of its own rules and regulatory freedoms that are not really available to the rest of the UK. And it's been criticized for acting like a tax haven and eliminating regulations on things such as executive pay. But it's still there. It's still going. The City of London is I think the oldest incorporated, in the modern sense of the term, city in the world.
and it keeps going strong to this day. The next thing I'm going to talk about is banks manipulating markets. Looks like somebody at the banks didn't want me to talk about banks manipulating markets. On a more serious note, there have been several scandals involving banks manipulating markets, whether it's the Libor rigging scandal, whether it's Goldman calling its unsophisticated institutional clients Muppets and giving them bad bills, whether it was what was going on with JP Morgan's silver position on both the short and the long side. There's been instances that banks have been accused of manipulating markets and have done so. It's not as often as people think. One, it's just there are a lot of people in this industry who have upstanding ethics. In fact, the vast majority of people work in finance, but it's just a simple risk-reward matter. Like, the downside of getting caught doing any of this stuff in terms of jail time and being banned from in the industry is far worse than usually the upside and maybe a slightly higher bonus you're going to get from manipulating the markets. And also, I think it's another thing it has to do with is the overestimation of the power of individual private banks. I mean, if you really want to be worried about banks manipulating markets, you should look at central banks such as the Federal Reserve and the ECB and the Bank of Japan, what they've done with their country's government bond markets. That's a real example of banks manipulating markets. Yeah, my expertise on the specific scandals that I've mentioned is not really suitable enough to go into, so I'm not going to really elaborate more on this here. The one other point I mentioned in Iceberg 7 was HSBC. I was going to add that to this series, but then I saw this video from Jake Tran, who covered the HSBC money laundering scandal and did it in probably a more entertaining and comprehensive way than I would have done with Iceberg. So if you want to learn more about the HSBC story, and which I have in later 7, I recommend watching his video. And then the Rockefellers, it's just kind of a derivative of the old money nobility thing. It's that the Rockefellers have a lot more influence than you would think they do, given the fact that they really haven't been much in the public eye since outside of a few charitable organizations since Nelson Rockefeller was vice president in the 70s. But I'll save that when I go more in my old money nobility series.